My name is Casey Barnett, and I am the president of ChemEd Business School. And it's my pleasure to welcome Mr. Blaise Colivas, and also all of you who are here in attendance for an exciting session on IFRS 18, which is part of the IASB and all of our efforts to continuously improve the quality and relevance of our financial reporting. Briefly, I'd like to introduce Blaise. Blaise is a director at W Consulting. And W Consulting is originally founded in South Africa. And South Africa has a highly developed securities market and also accounting and auditing framework and regulatory system, we can say. Just to give a hint as to its development, the Johannesburg Stock Exchange is one of the few stock exchanges in the world with a market capitalization of more than $1 trillion US. I believe around $1.36 trillion. Blaise is an expert in IFRS, and we met a few years ago when Blaise gave us feedback when we were developing the IFRS Resumes illustrated financial statements, which, by the way, Blaise, I'm very happy to tell you, has become a national template used by hundreds, if not thousands, of companies in Cambodia. Blaise is also a member of the South Africa Financial Reporting Standards Council, and also a member of the SME Implementation Group at IFRS Foundation. W Consulting is also joined by a board member of the IASB, Mr. Bruce McKenzie, who works together with Blaise at W Consulting. Blaise is also a deputy chairperson of the SAICA Accounting Practices Committee. And he was also previously a board member of the Accounting Standards Board of South Africa. And thank you very much, Blaise, for sharing your time and expertise with us. I'm going to be joining and learning from you too. Thank you very much. And everybody have a wonderful workshop.
Thank you very much, Casey, for that very warm welcome, and good afternoon, everybody, and welcome to the session. Happy Mother's Day to those mothers among us and those that are celebrating their mothers. And welcome to, what is for me personally a very exciting day because, as Casey mentioned, we are a team of IFRS specialists, and this session represents the first session on a new IFRS accounting standard since 2017. So it is quite a groundbreaking event for us. And not only that, because, obviously over the past several years, we've only had relatively minor amendments to individual standards, but it's the first major new standard coming out of the IFRS world for quite some time. I guess we are going to talk all about the requirements of IFRS 18, understand what it's about, why it came about, and what we need to take note of. Before I do that, I'd like to share a link for everybody who might want to download the slide notes and follow along. I know some of us like to do that, although everything is in the presentation ahead, so you can also just sit back and enjoy the session. But if you would like a copy, you can download by scanning the link, scanning the code in front of you. I will also, I think I can push out the chat. Let me just see if I can do that. There we go. I think I've just pushed it out into the chat for those that just want to click on the link and download the document from there. But as I say, it is just simply a summarized version of the slides that we'll be covering. Over the course of the next 3 hours, we will be looking at two broad areas in terms of our agenda or program. First off, will just be to understand the context, why IFRS 18 came about, what the background to the process has been, and it has taken the better part of 10 years to get to where we are today. So just to understand where the standard fits into the IASB's better communication projects. And then, of course, to take a dive into the new requirements of the standard to understand what is different, what's changed in terms of what we are all familiar with or used to. From a program perspective, the session is set to run for 3 hours. We will take a short little break, probably about an hour and a half into the start of the session, just to give everybody a chance to stretch their legs. But yes, the session is intended to finish at 5 p.m. Local time. So without further ado, of course, please feel free to feed any questions you may have through into the Q&A. And depending on timing, depending on where I am at the point where my attention is drawn to them, I will try and respond to as many questions as I can with the time available. In terms of IFRS 18, IFRS 18 didn't just magically appear out of nowhere. It wasn't just something that the board, the International Accounting Standards Board, woke up one day and said, you know what, let's go and change the layout of the income statement. Well, you'll see that's one of the things that's changed. But the background and the context behind the standard and the project that led to the publication of the standard is rooted in the IASB's Better Communication project. And this has its origins back in 2014, 2015, thereabouts, when the IASB undertook an agenda consultation, a public consultation process where the board reaches out to its stakeholders around the world to understand what are the issues that the standard setters need to address, what are the things that the standard setters need to prioritize. And essentially what stakeholders said at the time was that there was a need, or there was a perception of a need to identify or to address certain areas around the communication of financial information in the financial statements. It came about out of a concern from investors as one of the primary user groups of financial information, that in financial information either wasn't being appropriately communicated within the financial statements, either there was not enough relevant information being disclosed or too much irrelevant information, or ultimately we had some bad habits that companies had gotten into over several years, several decades, in fact, of following more of a compliance mindset when it came to financial reporting, rather than focusing on what provides quality information for decision making. And so the IASB decided to implement or set up the Better Communication project, which comprised a variety of different components. It wasn't just one thing. So when I say better communication, that's not what led to IFRS 18. IFRS 18 was just one of several components that came out of this better communication set of activities. In essence, just to relate it to the diagram on the screen, IFRS 18 comes out of the primary financial statements project, or component of the Better Communications project. We've also had, over the past several years, a number of disclosure initiative amendments. Those are amendments to existing standards, not so much a brand new standard that's been developed, such as we're discussing today, but rather amendments to existing standards to try and improve the quality of financial reporting through a variety of different initiatives. The IASB has also been looking at management commentary, but that project has taken a little bit of a back seat for the time being. Management commentary refers to the communication of information for decision-making outside of the financial statements. And prior to 2021, this is where, for example, companies might have communicated some degree of sustainability reporting, sustainability information, ESG reporting, as it's referred to, and other disclosures, other pieces of information that were communicated. So the idea of management commentary is that it's the intersection between the non-financial information and the financial information within the broader annual report that a company might produce. Why I say that's taken a bit of a back seat for the moment is that the IASB has decided to pause the project given that there's a new standard setting body within the IFRS Foundation that is focused specifically on the development of standards around sustainability information, the ISSB, the International Sustainability Standards Board. And so the idea behind pausing the project for the moment is so that the two boards can continue with their work, not working at cross purposes from each other, but then to ultimately see how their respective focus comes together within a series of connections. So that's something we'll revisit again at a later stage, but for the moment that project has been paused. And then down below it, we've also got various initiatives around the IFRS taxonomy, which of course is a method for the companies to report the information digitally. By digital reporting, I don't mean printing to a PDF document and attaching the PDF to an email, but rather tagging the information, the disclosures in the financial statements using a set of common tags or labels, which can then be utilized for the purposes of XBRL, Extensible Business Reporting Language consumption. Now, all of these different components of the project, as I say, were just part of the overall arching requirements of trying to improve how investors, who are the target audience or the primary target audience of a set of financial statements, can receive the information which will then ultimately be of a high quality and ultimately useful for decision-making purposes. And the next slide just summarizes what I'd already said. Essentially, there were three broad areas of concern, particularly with respect to the disclosure initiative, which the IASB had previously addressed through a number of, or a series of amendments over the past several years, to try and enable preparer judgment, emphasize the fact that the preparation of financial statements is driven by the judgment of management rather than compliance with a tick box or a checklist or some kind of template that the company has used to prepare its financial statements. The expectation is that by making these changes, that would lead to improved disclosure requirements, which ultimately would lead to improved disclosures and better communication. Very briefly on the disclosure initiative, because we have had a webinar on this in the past. We've run one for CAMID in the past, some time back, dealing with some various aspects of the disclosure initiative amendments. And what you'll notice if you just cast your eye over these, I'm not going to go into too much detail on any of them, given that our focus this afternoon is on IFRS 18 specifically. But you would have noticed, for example, that IAS 1 in particular has been amended a number of times for various aspects, primarily trying to emphasize this concept of materiality, trying to focus on materiality being at the heart of the disclosures in the financial statements. We've had a new and improved definition of material, which I'll just remind you all about in just a moment, because it is quite relevant to our discussion here. We've got a practice statement, which is a guidance document that the IASB published to assist companies, to assist management of companies as the preparers of the financial statements, to apply their judgments around assessing what information is material or what isn't material, so as to focus on the relevant information for reporting purposes. We've seen the publication of case studies that various companies around the world published, trying to demonstrate how they had embraced the principles of effective communication in the preparation of their financial statements, and in some cases completely reinvented the structure, the layout, the formatting of their financial statements, with an emphasis on trying to improve the user experience for the audience of the financial statements. We've also seen amendments to IAS 1 removing barriers to the application of judgment, emphasizing and confirming that even if a particular disclosure requirement is described in a standard as an entity shall disclose a certain piece of information, management is still required to assess whether that requirement will result in material information being presented, because for some companies, a particular disclosure requirement might not be considered material, in which case including disclosure just for the sake of ticking a box could result in unnecessary clutter that has the potential to obscure material, useful information. We've also seen amendments to the standard around the preparation of a statement of cash flows, requiring additional information to be presented around changes in liabilities. And the most recent of these, which actually only came into effect, I'll talk about the last one in just a moment, but the most recent amendment to IAS 1 that came into effect at the beginning of January this year is around the disclosure of accounting policies, where companies are now required to assess what accounting policy information is material in order to provide the information. And again, to try and avoid the inclusion of immaterial accounting policy information that only serves to clutter and obscure the important information. Right at the bottom of this list, and this was a very late amendment to the slide, in fact, as recently as 3 days ago, I've lost track of the days now. But during the course of last week, the IASB published another standard, IFRS 19, which we won't be covering today, but which also is part of the disclosure initiative, which introduces some relief to subsidiaries of listed companies or subsidiaries of companies that report in terms of full IFRS standards, where those subsidiaries themselves do not have public accountability. And would otherwise qualify, for example, to use or to report in terms of the IFRS for SMEs. But because their parent company requires IFRS information for the disclosures in the consolidated financial statements, IFRS 19 introduces a reduced disclosure framework for certain qualifying companies who will comply with the recognition and measurement requirements of full IFRS accounting standards. In other words, their reporting framework will be IFRS, not IFRS for SMEs, but the disclosures will be far reduced, far simpler as compared to what would be required otherwise for non-qualifying companies. So certainly going to provide some much needed relief within listed groups and large publicly accountable groups, where the individual components of the group in their own respective statutory accounts would qualify for some simplified reporting. As I say, all of these have gone quite a long way to improving the quality of financial reporting. And these standards have been running or these amendments have been running over the past several years, over the past decade, but they were only part of the puzzle. The other part of the puzzle, of course, was also looking at the structure and layout of the financial statements. And of course, that's what's culminated in IFRS 18 that we're discussing this afternoon. Just before we start looking at the background to IFRS 18 and the project to get there, the steps to get there, I just want to remind all of the viewers that the amended definition of material, which I mentioned on the previous slide, confirms that information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions that the primary users of general purpose financial statements make on the basis of those financial statements, which provide financial information about a specific reporting entity. So the definition of material that now applies in IFRS accounting standards, and which we'll refer to a couple of times over the course of the webinar, requires us to consider who the primary users of our financial statements are, primarily the investors. We need to consider information that could reasonably be expected to influence decisions taken by those investors. And we need to understand that the concept of materiality is, of course, entity specific. So to those of you that might be in the auditing space and might have a portfolio of clients, or for those of you that are within work for a particular company or will be working for a particular company, one needs to assess materiality within the appropriate context. And what might be material for one entity might not be material for another entity, either because the user base is potentially different, or perhaps the circumstances of the entity are potentially different, and in which case this is an ongoing and pervasive assessment that has to be made on a continuous basis. It's also important, and I just want to touch on it again before we move off the slide, it's also important to understand that obscuring information refers to potentially, as I mentioned earlier, the inclusion of unnecessary clutter, or perhaps scatter in information across the financial statements in a disjointed and very difficult to follow fashion, which means that even though you might have technically and officially disclosed all of the information around a particular transaction, event, or condition, if the users have no basis to relate or follow the trail, so to speak, within the financial statements, then you may as well have left out the information. That's essentially another aspect of obscuring. Another important aspect, which is going to come up again in just a moment, which is why I just want to touch on this again in a bit more detail, is where information around a material item has either been inappropriately aggregated with other items or inappropriately disaggregated with other items. So in a few moments, we'll talk about the concepts of aggregation and disaggregation, because that's one of the key pillars of the new IFRS 18 standard that we're going to be looking at. How a company determines when to group certain pieces of information together and when to separate them or keep them separate from one another. And then lastly, in terms of obscuring information, is where information is not clearly described. It's described in very vague or uncertain terms. And again, that's something that we're going to revisit again later when we describe the labeling of information, the inappropriate use of vague descriptions like other in the financial statements as line items. I know many of us see that all the time. We've seen it in the templates that we use. We might have described various line items as other just for the sake of summarizing the information. But if that vague description is obscuring important information around the nature of what is included in that item, then it is essentially viewed as seriously as a misstatement according to this definition of material. So this definition, as much as it came out of an earlier amendment to IS1, to a certain extent has also shaped the outcome of IFRS 18 that we're going to be discussing over the remainder of our time together this afternoon. With respect to the background to the standard, as I said, this came about back in 2014, so it's almost been 10 years in the making, coming out of the agenda consultation that had been undertaken at that time. And remember, an agenda consultation is undertaken approximately every 5 years. And so already back in the mid-2010s of that decade, investors were complaining about the fact that they find it difficult to absorb and make decisions around a company's financial information, either because the statements of profit or loss of companies vary in content and structure, which of course then makes it very difficult to compare one company with another in terms of financial performance. Another aspect that investors highlighted as being problematic is the fact that management often includes, well, it happens in different degrees, of course, but some companies provide what we call non-GAAP measures, non-generally accepted accounting practice measures, or as it's more formally described in the standard, in the language or literature of the standard, a management performance measure. By its nature, something that is non-GAAP, in other words, something that isn't defined or regulated by an IFRS accounting standard, or something that management has developed itself, by implication, suggests that it's anybody's guess what's gone in there. And that makes it very difficult to appreciate the value of a piece of information that is so-called management defined, where that doesn't have a benchmark or a reference point against which one can understand what's gone into that measure. So that was another criticism of financial statements that was raised back in 2014. And then lastly, and this again touches on that aspect of obscuring material information that I mentioned on the previous slide, where companies don't provide enough detailed information or where important information is obscured. And to a certain extent, I blame templates. I blame inappropriate use of templates. Those of you that attended my webinar a couple of years back on the disclosure initiative might recall that I'm not anti or against templates as such. What I am against is where companies assume that by simply importing a trial balance out of the accounting records into a template, you can suddenly just hit a couple of buttons and you've got financial statements. It's important that the information is tailored and adapted and assessed in terms of relevance for the target audience. So that was the third criticism coming out of the agenda consultation, which led to the addition of the project on primary financial statements. And over the past 10 years, we've had a couple of hiccups along the way. I recall right at the start of the COVID pandemic, the exposure draft on primary financial statements was published probably around January of 2020. And I mean, that's already 4 years ago, or over 4 years ago. We've been waiting for 4 years based on the feedback that was received on the agenda, on the exposure draft back in 2020 to understand how the IASB has been responding to these various demands and trying to get to an answer that improves how companies communicate in their financial statements, responding, of course, to these problem areas that I've mentioned on the previous slide. So on that note, then, I guess it's my responsibility here to present IFRS 18. IFRS 18 is a brand new IFRS accounting standard. It is the first IFRS accounting standard published since IFRS 17 on insurance contracts, which was issued back in 2017. And the significance of this is that it will also replace IAS 1, the standard that a few slides back you saw had been amended so many times for various elements of the disclosure initiative over the past several years. IAS 1, the very first international accounting standard that was issued back in the 1970s, that serves as the core standard that applies to all companies, irrespective of their industries, irrespective of their countries. IAS 1 has always required, or rather provided the principles, the fundamental concepts that underpin any set of financial statements. Now, the question is, why was it necessary to replace IAS 1? And you'll see as we go deeper into the discussion, a lot of IAS 1 continues and survives. It's not to say now that IFRS 18 is wiping the slate clean and we are now starting with a brand new standard from scratch. I personally believe that the reason why IAS 1 could not be maintained is just because of the extent of the editing and the additional paragraphs that were added, primarily around certain aspects relating to the 3 issues that I've mentioned being at the heart of the project. It became more of an editorial challenge to try and fit them into the existing paragraph structure, especially when you consider that where you've got a sequential number of paragraphs and you add in new paragraphs, you now need to supplement them with capital letters and things like that. It's primarily around an editing challenge rather than conceptually saying that IAS 1 is not fit for purpose. The principles of IAS 1 will be carried forward into IFRS 18, and there will be a lot of similarity as we go through it. You'll see that many of the paragraphs will be word for word copy and paste from the old standard. Others will be slightly restructured, slightly reworded to take into consideration changes in terminology, take into consideration some of the principles that we've been discussing that we will be looking at over the course of the session. And also understanding that some of the IAS 1 principles might not go into IFRS 18, but will go into other standards instead. So again, that's more of an editorial element. It doesn't necessarily change the principle, because whether you're applying it from an IFRS 18 perspective or whether you're applying it from another standard, you will simply just need to follow all of the standards that are relevant to you. I see a question that's come up already in terms of when is the effective date. We are jumping the gun, but I'll answer it now just for those that are desperate to know when all of this comes into effect. The effective date of the new standard, and hence also the removal or the withdrawal of IAS 1, is for annual periods beginning on or after the 1st of January 2027. We will revisit this again later on when we talk about transition, when we talk about the effective date, but the effective date is some time away, at least insofar as calendar years are concerned, but it is also available for immediate adoption for companies that want to early adopt the standard already. Right. So I think let's start going deeper into the requirements. I mean, in essence, we've spoken about the user need, we've spoken about the investor need. So I guess this is to a certain extent repeating what was already identified as the problem statement back in the agenda consultation in 2014. What investors want is comparability around financial performance. So in essence, that will then lead to one of the core or one of the fundamental changes brought about by IFRS 18, introducing certain required subtotals that will allow for comparability and also provide guidance around aggregation and disaggregation, clearer conceptual guidance around aggregation and disaggregation. One of the changes that will come through is more discipline around an operating profit or loss subtotal, which currently under IS1 is not defined, even though many sets of financial statements include such a subtotal. So providing more guidance around that. The standard will also then introduce new requirements around, new rules rather, around the presentation of non-GAAP measures, those so-called management-defined performance measures that I mentioned earlier, by requiring certain disclosures to be provided, by explaining how they need to be presented, and also providing a bit more discipline around how those are communicated to the investors. And ultimately, then IFRS 18 will enable companies to communicate the information more effectively and more consistently, which fits into the broader Better Communication project that I mentioned at the start of the session a few slides back. IFRS 18 is going to apply to all companies across all industries. So if a company reports in terms of IFRS accounting standards, it will be required to apply the new standard in terms of the when the standard becomes effective. That being said, IFRS 18 is not going to change the profit or loss for the year. It's not going to change the net asset position. It's not going to have any impact in terms of recognition and measurement. So while it is something that is going to be pervasive and affect everybody out there, it's not going to change the numbers. It's going to change how and where the numbers are communicated and presented, but the numbers will ultimately remain the same. So you'll see that getting to the bottom line of the statement of profit or loss, which, as I said, is not going to change, might involve some intermediate steps in terms of where we present certain items of income and expenses, but the profit or loss will be the same at the end of the day. But by introducing these intermediate steps, these subtotals, by specifying where certain income and expenses need to be presented, it will allow investors that are assessing the company's performance, assessing the various aspects of the total profit or loss for the year, to then better compare one company with another, and take out the contradictory and conflicting incomparable principles that companies have been following up to this point. So those are the three sets of new requirements: improving comparability in the statement of profit or loss, the income statement, as I'll refer to it a couple of times. I think most of us are familiar with that terminology. Enhancing the transparency of management-defined performance measures, and also providing more useful grouping of information in the financial statements. For the first one, for the improving comparability in the statement of profit or loss, IFRS 18 will essentially introduce three new defined categories for the classification of income and expenses. So income and expenses that a company incurs or earns during the course of the year will have to be categorized or allocated either into the operating category or the investing category or the financing category. And I'll explain the principles around that as we go further into the discussion. And through the introduction of these categories, the implication is that each category... Sorry, there seems to be a... Okay. Through the introduction of these new categories, the implication will be that each category will have a subtotal to differentiate it or to separate it from the other categories. And those are essentially the new defined subtotals which IFRS 18 will introduce. And that hopefully will then also introduce a consistent starting point for the analyzing of performance, which will then also make it easier to compare companies, as I mentioned previously. On the enhancing of transparency of management-defined performance measures, the idea here is that IFRS 18 won't prohibit companies from disclosing alternative or different management-defined performance measures. Technically, they've always been permissible. IS1 has never said a company can't present alternative measures of performance. That's why, for example, you'll see many companies present subtotals and shine a spotlight in their public communications around an earnings before interest, tax, depreciation, and amortization, an EBITDA or an EBIT, and various similar types of subtotals. Sometimes they might present so-called normalized earnings or use different descriptions. But in essence, these are a way of assessing performance that management believes is relevant in looking at how the company has operated during the course of the year. So by continuing to allow the use of these management-defined performance measures, MPMs, as they will be described later on in the presentation, that continues, but companies will need to explain what they are, why they are important, how they have been prepared, as well as provide additional disclosures where, for example, there's been a change in a management-defined performance measure, and also reconciliations to the nearest comparable IFRS defined subtotal. And then on the third pillar of IFRS 18, the third major element of the new standard around the grouping of information, the standard will set out enhanced guidance on how to organize the information and also explain or provide new principles that will help preparers of financial statements to understand whether information should be presented in the primary financial statements or in the notes, by explaining the roles of the two, as well as providing more transparency around the composition of operating expenses, which is essentially a very important element of financial performance. So those are the key elements or the key portions, if I can call it that, of IFRS 18 that we will be discussing over the remainder of the session. I see a couple of questions have come in. Let me see if I can address them before we move on. Practical experience on the materiality assessment for drafting the annual financial statements. I'm afraid I can't answer that within the time available. Our focus is on IFRS 18, and I just mentioned the materiality guidance and judgments as a foundation for understanding some of the changes. But if there's a demand for a materiality workshop or something like that, we can certainly look to hosting a webinar focused on that going forward. Regarding the slide handouts, we have sent out the links. I'll send out once again for those that might have missed it into the chat. But these will also be shared with you after the session in the post-event communications. Then Anonymous says, do you think the company should start to categorize their income and expenses according to the new standard? Let's pause that question for the moment until we get to the transition requirements or considerations. Because later on you'll see I've got a portion of the session talking about what the implications of the changes will be for some companies that are unlikely to be affected significantly, because either they are very close to where they are already, nothing prevents you from already adopting the standard. It is available for early adoption, but some companies might wait till the 11th hour because they might need to make some changes to their systems in advance and might require more time. That's why the board generally gives us a lead time, in this case of 3 years, to allow those companies time to make the changes. And then the question around the subtotals regarding the statement of profit or loss and the statement of cash flows. There are differences. Again, I'll come back to this in a bit more detail when we consider the consequential amendments to other standards. IAS 7 has been amended in some respects and not amended in others. While the categories are similar, we've got operating, investing, and financing under IFRS 18, and we've got that for the statement of cash flows. They are not identical, but that's something that the board is now going to be looking at with a new project that they are embarking on. So for the moment, we need to understand the concepts of the categories from an IFRS 18 perspective, and the IAS 7 perspective of the three categories might be different in some instances. Right. Let us have a look then at the scoping of the standard. So in terms of the standard, the scope is very similar to that of IAS 1. It sets out the general and specific requirements for the presentation of information in the statements of financial performance, statement of financial position, and statement of changes in equity. It doesn't set out the requirements for the statement of cash flows. That's still catered for in terms of IAS 7. And of course, it has nothing to do with recognition and measurement, because as I said, recognition and measurement is the subject of other standards. And of course, other standards may also have their own disclosure requirements in addition to the accounting requirements. But these are the core principles that apply irrespective of specific assets, liabilities, income, and expenses. And it interacts and aligns with, in many respects, the requirements of other standards. So one needs to apply both IFRS 18 and the relevant other IFRS accounting standards in order to prepare the financial statements correctly. In terms of the role of the primary financial statements versus the notes, I'd like to undertake a short little poll. So if those of you that do have your mobile devices handy, if you could please click on or rather scan the code in front of you. I will also paste a copy of the link into the chat for those of you that do not have your mobile devices handy. Just get that running. So the question that's been asked in the poll is, which of the following items, and you can obviously select more than one item, which of the following items form part of a complete set of financial statements according to IFRS accounting standards? This will also help us set the tone in terms of a discussion around what is the role of primary financial statements versus notes and other information in an annual report. So if you could please click on the link that I've just pushed into the chat, or scan the QR code on the screen in front of you. And I just want to see how the responses are looking, and then I shall share the results in just a moment. Just giving everybody a chance to respond. The poll is completely anonymous. You will still get your CPD, whether you get the answers right or wrong. I just want to get a sense from you as to which of these items constitute or form part of a complete set of financial statements according to IFRS accounting standards. Give it another minute or so, and then we will respond. I will share the responses and the correct answers as well for those that like to mark their own homework. Right, let us have a look at the responses. So out of the 221, I haven't closed the poll, so I'm sure numbers will increase still, but out of the responses thus far, let's just scroll there. Right, some mentioned the chairman's report, the director's report. I'm glad to see that there was quite a lot of support for the cursor there. Statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, funnily enough, was not as popular as the other two. The statement of cash flows also not as popular as the other two. And then statement of compliance with laws and regulations, handful of support there. ESG report and the report of the independent auditors. And then lastly, quite a bit of support for the notes. If we just compare the correct answers, Let's just flip this around. So the correct answer, ladies and gentlemen, is a complete set of financial statements according to IFRS accounting standards comprises 4 primary statements, being the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flows, and those 4 primary statements are supported by the notes to the financial statements. So anything else, all of the other answers that were provided, those of you that said the auditor's report, for example, or the ESG report, very limited support there, but nevertheless, there were some that responded there. Those might form part of a financial report, but they are not the financial statements. The financial statements are what falls within the scope of the International Accounting Standards Board. That's, of course, what we are discussing over here. And IFRS 18 then explains why we've got 4 primary statements, and then we've got the supporting note information, and explains how we need to present information across those documents. Any other information that is presented over and above that, maybe the laws of the land require certain categories of companies to be audited, in which case one would expect a report of the independent auditors to be in the annual report, but that's not an IFRS issue. That's a regulatory issue which is driven by your company's legislation. And that means that you can't have information or disclosures in the report of the auditors that IFRS accounting standards require to be in the financial statements. There are limited instances across IFRS accounting standards where information can be cross-referenced to other documents outside of the financial statements, but those are specific exceptions and cannot be applied by analogy across all other disclosures. So I mentioned this in particular because if we just go back to, apologies, let me just turn off my pointer there. If we just go back to the top over here, many of you mentioned, well, some of you mentioned the director's report, for example. And the director's report often provides some management commentary, some additional information around management's commentary on the results for the year and so on. It would be inappropriate to include disclosures that our IFRS accounting standards require in the director's report unless a particular standard specifically makes such an allowance or creates such a possibility. Right, so understanding the role of the different documents. I mean, why then do we have 4 primary statements and then the support of the notes? What's the difference between the two? Is it up to management to decide whether something's disclosed in the primary statement of financial position, or can it be disclosed in the notes? Some standards actually specify that a choice can be made and it can be presented in either the primary document or in the notes, supporting note information. In other instances, the standards are silent about where the information must be presented, and that's where it becomes important to understand the role of the primary statements as compared to the notes, so that we can then decide where the most appropriate place is to put the information, the disclosures. In essence, IFRS 18, which, by the way, IS1 never really explained in detail, and this is why I say this is quite an improvement in my opinion. IFRS 18 explains that the primary financial statements are intended to provide a useful, structured summary of the reporting entity's recognized assets, liabilities, equity, income, expenses, and cash flows. Let's just pause there for a moment. Let's look at those elements of an entity's financial accounts. The assets and the liabilities and the equity are presented in the balance sheet, in the statement of financial position. Movements in the equity are presented in the statement of changes in equity. Income and expenses are presented in the statement of profit or loss and other comprehensive income, and cash flows are presented in the statement of cash flows. So all of these elements of the entity's recognized, assets, liabilities, equity, income, expenses, and cash flows are essentially sorted and grouped into one of the four, or sometimes in both, two of the four, because, for example, when it comes to equity balances are presented both in the statement of financial position, as well as movements therein are presented in the statement of changes in equity. But in essence, what we're doing is we are structuring and summarizing these various components of the entity's accounting records into one of four different summaries or structures. And the intention behind these useful structured summaries is to allow users, again, the investors primarily, to obtain an understandable overview of the recognized items or components, to allow for the making of comparisons between entities, and also between reporting periods. For those of you that are involved in looking at analytical ratios and assessing financial health of companies, most analytical ratios are performed based on the information coming out of the primary financial statements rather than the notes. And then the third aspect of the primary, or the third role of the primary financial statements, is to identify items or areas about which the users might want to obtain more information, which will then be provided in the notes. So that's essentially what distinguishes the primary financial statements from the notes. But both of those, the primary statements and the notes, together need to be assessed holistically or collectively in order to fully appreciate the financial information of the company. The role of the notes, by contrast, is to provide material information that's necessary to understand the line items from the primary financial statements and to supplement those primary financial statements with any additional information that achieves the objective of the financial statements. So that, I mean, one might have understood that implicitly prior to IFRS 18, just in terms of understanding what was included in the primary statements and what was in the notes. But for the first time, we now have explicit clarity in terms of this, which will also help companies to assess whether to include something in the face or on the face of one of the primary statements or in the notes, particularly where a choice is made available. That also means, of course, that how we aggregate and disaggregate information will serve a purpose, or serve a role rather, in terms of how we summarize the information in the financial statements. Because what you may find is that a line item in a primary financial statement is an aggregation of items, which is then disaggregated in further detail with more explanation in the notes to the financial statements. And that is true for many of the disclosures in the various notes. Often you'll simply have a line item on the face with a cross-reference to a note disclosure where that line item is broken down into more detail with additional explanations, both qualitative and quantitative. And that also then is where the notes deal with some of the additional disclosure requirements that come from the various other standards. So, for example, when one looks at the disclosure requirements of financial instruments, we have certain disclosure requirements about the risks of financial instruments and other types of disclosures that aren't necessarily just taking the line item and disaggregating it, but providing more context, more explanation to the numbers that have been recorded in the primary financial statements. One last comment I want to make on this before I move on to other general requirements is that, technically speaking, while the standard does have an order and essentially says that you've got the statement of profit or loss and or statements of financial performance, as it's now described, which comprises either a statement of profit or loss and a statement of comprehensive income, or a combined document. And then you've got the statement of financial position, and then you've got the statement of changes in equity, and then the requirement for the statement of cash flows. While they are listed in that order, it doesn't mean that the one is more important than the other. Which is why I just make that comment with reference to the results on the poll, where some of you almost seem to think that the statement of changes in equity or the statement of cash flows was voluntary or additional information or not very important information. They are all equally important because they all portray a different summary of a different aspect of the company's financial position, financial performance, and cash flows for the year. And that's why they are of equal primacy. It's not to say that the balance sheet is more important than the income statement, or that both the balance sheet and the income statement are more important than the cash flow statement. Having said that, and just using the terms that I just threw out a moment ago, if we choose to use different terminology, if I call the statement of financial position the balance sheet, and if I call the statement of profit or loss the income statement, that is absolutely perfectly acceptable. In fact, even the standard setters themselves, as much as the technically formal term is statement of financial position, statement of profit or loss, you'll find that colloquially most of us still refer to balance sheet, income statement. And I think most people understand that as long as you aren't misleading the users of the financial statements by describing something in terms that are unfamiliar or perhaps that are inaccurate, then it's perfectly acceptable to use whatever title or description you want to use for the document, for the statement. Just some other fundamental pillars of IFRS 18. And for the next couple of slides, these aren't necessarily going to be very different from what we already had under IAS 1. Again, just to confirm that IAS 1 does carry many of the existing principles unchanged. In essence, we need to identify each primary financial statement and the notes and disclose prominently and with appropriate repetition if necessary for understandability, the name of the entity or other means of identification, whether the financial statements are for an individual entity or a consolidated group, the date of the financial statements and the reporting period covered, the presentation currency, and the appropriate level of rounding that's been used for the amounts in the financial statements. Most of us probably just understand that these are required anyway, so we didn't necessarily need the standard to tell us this, but it is helpful to compare to make sure that we have covered all of the information. For me, the most important one is this bottom one over here, the level of rounding used, because often some companies report amounts in thousands of currency units or millions of currency units, as the case might be, but then in the narrative note disclosures, they provide it in full. So it's important that the users are very clear in terms of what the numbers relate to. Otherwise, the information can become completely meaningless and incomprehensible. Regarding the frequency of reporting, again, most of us are probably quite used to the idea that a company will typically report at least annually, either 12 months or 365 days or 52 weeks, or however you choose to slice and dice your annual period. It is possible that a company might change the end of its reporting period, which means that a particular set of accounts could have a longer or shorter period than 1 year, in which case it's just important to clarify that by confirming what the period is, in fact, and also highlighting the fact that the comparative information might not be directly or entirely comparable. And on the point of comparability and comparative information, it's also important that we retain the presentation and disclosure and classification of items from one period to the next, unless it's apparent that either there's a need to change because of changes in accounting policies that have been applied, or perhaps a correction of a prior period error, or maybe there's a new standard that has been issued that requires a change in presentation or disclosure. Some standards do allow for certain choices across accounting policies. For example, to present certain items in other comprehensive income as opposed to in profit or loss, or whatever the case might be. And where those choices are made, the idea is that once the choice is made, you stick with that choice. The only time you would ever be permitted to change your mind in terms of an allowed alternative is where the new change or the change that you're moving towards will provide more reliable and more relevant information than the original choice that was made, in which case you also need to disclose the reasons for having made the decision to change the information. I mention this point because often when I review financial statements for compliance with IFRS accounting standards, we often see simple descriptions to say in certain circumstances the comparatives have been restated to allow for better presentation. I would argue that's insufficient to fully appreciate and understand why the new presentation provides for better information. It's important to be specific as to why it's changed. And then, of course, we also are required to present at least 1 period's worth of comparatives for all amounts that are reported in the current period's financial statements. So across the primary financial statements, as well as through the note disclosures, for every disclosable amount, we have to present current and prior year. Again, most of us are familiar with this, so it's probably not a new concept to anybody. That being said, some standards do allow for exemptions where they say, for example, that, excuse me, they say that a particular comparative disclosure is not required, which allows for some expedience, some relief in terms of the disclosure. Only if a standard specifically caters for or specifies that comparatives are not necessary are you allowed to not provide comparative information. Otherwise, IFRS 18 specifies that all amounts require comparative information, and that might need to be supplemented, not only just the comparative amount, but also with narrative and qualitative descriptive information that enhances an understanding of the current period's financial statements where appropriate. So, for example, you might have a situation where a company in the prior year undertook a business combination. Now, a business combination comes with a lot of disclosure that is necessary in the period in which the business combination occurs. In the subsequent period, it's probably not necessary to repeat all of the qualitative and descriptive narrative disclosures around the business combination, except if that's then necessary to understand why, for example, in the current year, you might have had an impairment of some of the goodwill that you recognized in the previous year. So where there's a continuation or a linkage to the disclosure, then you need to consider what additional disclosure needs to be provided in the current period insofar as it relates to previous periods. You can also provide additional comparative information on an ad hoc basis. What I mean by that is that the general rule is current and prior for all amounts, but you could theoretically elect to provide additional 4 years worth of income statement disclosures if you want to demonstrate, say, a 5-year trend of profitability. That doesn't mean now that you also then have to provide 5 years comparatives for the balance sheet and 5 years for the cash flow statement. You can limit it to the comparative disclosures for the income statement, provided that all of the comparative periods are compliant with IFRS accounting standards. You can't have pro forma information in your additional comparatives, and you need to provide appropriate supporting note disclosures to the extent that it relates to those comparative periods. In other words, the appropriate disclosures around any of the income statement items for the additional comparative periods presented. But that's voluntary. There's nothing that says you must do that. It's just that the standard permits the presentation of additional comparative information subject to these 2 requirements being satisfied. Where a company does change an accounting policy or retrospectively restates items or reclassifies items, then it's important to present not only an explanation as to the numbers that have changed and the new amounts accordingly, but you need to disclose the nature of the reclassification, the amount of each item or class of items reclassified, and the reason for the reclassification. One last point I want to mention on this then before we start looking at the concepts of aggregation and disaggregation is that don't forget that there is a peculiar requirement in IFRS accounting standards for the inclusion of an additional comparative statement of financial position. In other words, one needs to present an additional comparative balance sheet as at the beginning of the previous comparable year in relation to the current year, if an entity has had a reclassification or restatement of an earlier period that materially affected the balance sheet as at that date. I'll repeat that again. Where there's been a material reclassification or restatement of the comparative balance sheet as at the beginning or preceding the beginning of the previous calendar year or financial reporting year, then you need to present an additional 3rd statement of financial position, but you don't need to provide additional note disclosures in relation to the balance sheet position at that point. And it's only if the balance sheet was materially affected by the restatement in question. So if your restatement was around reclassifying line items in your income statement, because I think that's something that will come up later as we start talking about transition based on all of this discussion, companies will not have to present an additional third balance sheet in relation to the adoption of IFRS 18 simply because of the restatements arising from the new income statement items, unless, of course, there are other restatements that affected the balance sheet comparatives. Then the third balance sheet requirement kicks in and will have to be presented. So those are some of the fundamental pillars or foundations of the requirements of IFRS 18. But now let's start talking about some of the areas that are new, things that either have been evolved further, where now we've got more explanation. And one of these in particular is around the concepts of aggregation and disaggregation. IAS 1 has always had requirements around aggregation and disaggregation. It's always said that an entity should aggregate similar items and present them together, and should disaggregate dissimilar items unless they are immaterial. So that was always the overarching principle in the original IAS 1. The concept of aggregation and disaggregation comes from the fact that for a typical company that operates for an entire financial reporting period of at least a year in most cases, you will probably be processing large numbers of transactions or other events or conditions, which ultimately then give rise to assets, liabilities, income, equity, expenses, and cash flows. And so when we talk about aggregation, what we are saying is how we group these large individual items together into summaries or groupings, which we then refer to as line items. So a line item is an aggregation of assets, liabilities, equity, reserves, income, expenses, or cash flows. Obviously not all. So you can't have an aggregation of an item that's an asset and a liability. That's an offsetting, which we'll talk about in just a moment. But to the extent that you've aggregated various assets together into a single line item, to the extent that you've aggregated various liabilities together into a single line item, that's essentially where the concept of aggregation and disaggregation comes from. Disaggregation, of course, is the opposite, where you're taking a line item and breaking it down into its component parts. And so the question around whether to aggregate or disaggregate line items comes down to an assessment of the characteristics of the component parts. IFRS 18 has expanded the principles of aggregation and disaggregation. Remember, this was one of the concerns raised by investors at the start when the project first came onto the work program, to say that companies are grouping things together in a way that is not helpful or perhaps not understandable. So IFRS 18 has now introduced principles of aggregation and disaggregation that's confirmed that you need to classify and aggregate your assets, liabilities, equity, income, expenses, or cash flows based on shared characteristics or similar characteristics. And you need to disaggregate items based on characteristics that are not shared. Originally, it just said similar or dissimilar, but now the concept of similar and dissimilar is expanded to say that there must be some kind of shared characteristic at play in assessing whether it's appropriate to aggregate or disaggregate. The idea behind the aggregation and disaggregation is to ultimately end up with line items in our useful structured summary, i.e. the primary financial statements. So that's what we're after over here, is to say we are presenting our primary financial statements as a useful structured summary of whatever is included in that primary financial statement. So in terms of identifying the various line items and how to summarize that, we need to assess the appropriate grouping on the basis of what's going to provide the most useful information to the users. That means, however, that something that's aggregated on the face of a primary statement might need to be disaggregated into more detail in the notes in order to provide fully, all of the material information that the users need to appreciate and understand those items that have been summarized in the primary financial statements. And then a further concept that's quite important, and again, it goes back to my starting point around the definition of material. That's why it was so important for us to just go through that at the start, is to say that it's important to ensure that we don't aggregate and disaggregate, we don't aggregate or disaggregate to the extent that we are obscuring material information. What that means is that if you are aggregating dissimilar items together, then you are potentially obscuring information because of the fact that there are no shared characteristics between those items. So that would be inappropriate aggregation. If you are separating items that are essentially, for all intents and purposes, the same, and presenting them as being different when they've got shared characteristics, again, you could be obscuring material information through inappropriate disaggregation. So once again, highlighting the fact that aggregation and disaggregation is critical for assessing whether or not material information is being presented in the financial statements, which of course is at the heart of the objective of financial reporting, providing useful information that will influence the users of the financial statements. The standard explains the process of aggregation and disaggregation by way of 3 steps. And step 1 is firstly to identify the various assets, liabilities, equity, income, expenses, and cash flows, which arise from the individual transactions or other events. So these are the multitude of individual items that are recorded throughout the financial year in the accounting records. Our books of account will record the individual transactions, and we need to identify what those are. What we typically do is that we group those transactions into charts of accounts in our general ledger, but that doesn't necessarily mean now that the chart of accounts is adequate or sufficient for the purpose of aggregation, because you might have different ledger accounts in your financial statement, in your accounting records that also share similar characteristics and could therefore also be aggregated with one another. So there could be various degrees of aggregation that are being assessed as part of step 1. Step 2 is to classify and aggregate the items into items based on their characteristics. So step 2 requires us to identify whether there are any similar characteristics between the various items. As I said, a starting point might be a chart of accounts in the general ledger, but that might not necessarily ultimately be the same as the line item that gets recorded in the financial statements. For the purposes of assessing similar characteristics, the standard explains you need to consider whether the items are similar in terms of nature or function or measurement basis or some other characteristic. It could be by geographical region. It could be by customer type. The standard doesn't limit us in terms of us assessing what the similar characteristic is. What it does say, though, is that a similar characteristic does not mean that it's a shared definition. So you can't simply say, well, I've got two asset types, and because they both share the definition of an asset, according to the conceptual framework, that is a similar characteristic that I'll then group together. Already you can start to see that simply grouping together items on the basis that they are assets is problematic. And some companies may have been doing this in the past, where, for example, you see descriptors of other assets or other financial assets. Other financial assets in and of itself doesn't mean that they've got similar characteristics when one considers, for example, that financial assets could either be debt instruments or equity instruments, or have different measurement bases. So while they haven't quite said it here, it's coming up a little bit later on when we talk about the description of other. In essence, what we're saying is you need to look beyond just the fact that you've got two things that happen to both be assets or two things that both happen to be income or expenses or whatever the case might be. There may only be one shared characteristic across a variety of different items, and the more shared characteristics, the less likely it is that you will have to further disaggregate the items in the notes. The fewer shared characteristics you have, the more likely it is then that you may need to provide more detailed, more granular disclosure in the financials, in the notes of the financial statements, to further provide material information about these items and highlighting the dissimilarities where such dissimilarities exist. And then the third step is to disaggregate items based on dissimilar characteristics. Again, what we're trying to achieve here is a useful structured summary. So what we're saying is a single line item that just summarizes or aggregates lots of items, providing useful enough information to assess financial performance, financial position, cash flows. You may want to disaggregate items the more dissimilar characteristics exist in relation to that. In the primary notes, in the primary financial statements, but certainly in the notes, you may need to provide more detailed disaggregation in order to provide the material information. Remember, of course, ladies and gentlemen, that at the heart of everything we're discussing over here is the concept of materiality. And materiality obviously takes the user needs of the financial, the users of the financial statements needs into consideration in assessing what information they would typically expect to see or require in order to make decisions in relation to these financial statements. I did mention earlier that taking an asset and a liability and aggregating them together is essentially offsetting. And the standard has a general requirement that's been carried forward from IAS 1 unchanged to say, you shall not offset assets and liabilities or income and expenses unless specifically required or permitted to do so by an IFRS accounting standard. Often we get asked questions, can I take this income and this expense and show them on a net basis? And the answer is no, unless a standard specifically requires it, or unless the offsetting actually represents the economic substance of the transaction. Typically what happens, for example, if a company is acting as an agent on behalf of a principal, and therefore might be incurring expenditure and earning income, but that income and expenditure is being earned on behalf and incurred on behalf of its principal, then it's actually not reflecting the true substance of showing the gross income and the gross expense. Rather, the net position represents the substance of the transaction, and that would then effectively represent rather be a fair presentation of the substance of that transaction. There are also some standards that specifically require offsetting by virtue of the accounting methodology. For example, in the determination and measurement of defined benefit plans for the purposes of IAS 19 employee benefits, what a company needs to do is to determine or measure the defined benefit obligation to the employees, to measure the plan assets that might be attached to that plan, and then present the net position either as a surplus or as a deficit, which represents the defined benefit liability or asset, as the case might be. So there's an example where offsetting is required by virtue of the accounting methodology of the standard. My last comment here is that some standards require a net presentation, for example, where you've got a receivable and you've got an allowance for credit losses, for expected credit losses. That's not offsetting an asset and a liability. That's presenting the recoverable amount of the asset according to the requirements of IFRS 9. And so that's also not affected by this prohibition on offsetting, which has been carried forward into IFRS 18. Another important general principle is how we describe our line items. And I alluded to this earlier, which is that we mustn't describe our information in vague or uncertain terms. Again, this is another feature of materiality based on my earlier comment, is to say, if you aren't using or describing items with appropriate descriptions, then you are potentially obscuring the usefulness of the information. And it's as bad as if you had misstated or omitted the information altogether. So in describing or in determining how we describe our line items, it's important that we choose our labels and descriptions in a way that faithfully represents the characteristics, and that will be driven by how we've aggregated the items. For example, if we've aggregated certain items, it's helpful to explain what the similar characteristics were that were used in arriving at the aggregated line item. We often get asked questions from our clients who ask us, what must we call this? What should we call this in the income statement or in the balance sheet? And the answer is, call it whatever you please, as long as you are clear as to what it relates to. So too often we try to fit it or squeeze it into a general template or a description that's used in a template, expecting that it must have a particular title, and that couldn't be further from the truth. Where we've aggregated items together that have been aggregated, taking into account this entity's specific circumstances and the shared characteristics, you would probably be best suited in explaining exactly what that shared characteristic was in arriving at that number and saying that this represents assets of a particular nature, and that's the title that we give to the items. Another important caveat is to avoid the use of the term other. I'm sure you've all seen this. You've all seen descriptions that say other financial assets or other expenses, other income, and things like that. Before you settle on other, first ask the question whether a more descriptive label could provide more useful information. Why are we settling on other? Is it because the items that remain are truly, truly immaterial? It's unlikely if the other category is larger than some of the other items that have been separated or presented separately. But yes, if the items are truly immaterial, then it would be helpful to explain that, to say other immaterial operating expenses, rather than simply just describing it as other expenses. But if a more appropriate description, or if a better disaggregation would provide more useful information, that should be your first prize before settling for a description of other. As I said, if the aggregation contains items where the information is truly immaterial, then it would be helpful to explain that, to say that other represents immaterial items, whether you do that in the description itself or in a footnote that explains the description. You may need to explain, for example, that there are no items included in this total for which information would be material, or an explanation that the amount comprises several items for which information would not be material, with possibly, and this is an example, an indication of the nature and amount of some of the largest items, to give the users an understanding of what is sitting in this global lump sum value that's described as other in the financial statements. So that, ladies and gentlemen, explains some of the principal core fundamental requirements of IFRS 18. And up to this point, as much as I've mentioned a couple of times that we'll be talking about the statement of financial performance, everything that I've described here, the concepts of aggregation, disaggregation, materiality, label descriptions, and things like that, apply equally to all items in the primary financial statements. That means it applies to the balance sheet, the statement of profit or loss and other comprehensive income, to the statement of changes in equity, as well as in the statement of cash flows, and to the notes to the financial statement. So the new requirements are primary statement agnostic. They don't only apply to certain types of primary financial information. But the main area where the most change is likely to come, because up until now, I think most of our discussion up to this point could have been accommodated within IS1 without too much change, because it was simply expanding on existing principles of aggregation, disaggregation, materiality, and structure, and so on. But what has changed quite significantly is the requirements around the statement of financial performance. But before I move on to this, I think we are more or less halfway through the session. So I'm going to pause for a moment before starting the session and then taking a break in the next 5 minutes. So I'm going to break for, give everybody a chance to just stretch your legs, grab a cup of coffee, a 10-minute short break. And when we come back, we will talk through the new requirements for the statement of financial performance. See you all in 10 minutes. Right, welcome back, everybody. I'm assuming that everybody can still hear me, and I hope you all enjoyed the break. So, just to take stock of where we are, I'm going to just press send on the chat again for those that might have missed the earlier link for the handouts. I appreciate some of you might have joined after we had shared it originally. And then just a reminder to everybody that to the extent that any of you do have any questions, to please feed those through in the Q&A. I won't be taking any responses over microphone, but if you do have any questions, please to feed those through in the Q&A window. Right, so we are still discussing IFRS 18, as I'm sure we expected to still be busy with it. But just before the break, I said I was going to introduce the main focus of the changes, the things that are going to be the most different, I think, for most companies who apply IFRS 18. Despite, of course, the clarifications and the improved principles that we've discussed up to this point from a foundational perspective, comes around the so-called statement of financial performance. Technically, IS1 never really defined it as such. IS1 used to require still does, I guess it's not yet gone, but when it's replaced by IFRS 18, IS1 requires a statement of profit or loss and other comprehensive income to be presented. And that can either be presented in a single statement of profit or loss and other comprehensive income as two separate portions of the same document, or you could have a separate statement of profit or loss and a separate statement of other comprehensive income, in which case you would just present the same information across two different pages in the financial statements. That concept of having these statements doesn't necessarily change, but now what the standard does is it describes this document, the statement of profit or loss and other comprehensive income, as being a statement of financial performance, because that's what is represented in those two components of the document. You've got profit or loss, you've got other comprehensive income. Collectively, the total comprehensive income of a company for the year is the financial performance of the company. So in that sense, with a little bit of new wording and a little bit of a new description, we still have to present the information around financial performance in profit or loss and in other comprehensive income. But the standard introduces some new requirements around how to do that. Under the current guidance of IS1, we have to present in the portion covered by a profit or loss certain specified line items. So in addition to any other specific disclosure requirements of another IFRS accounting standard, we need to present an amount for total revenue. We need to present total finance cost. We need to present total equity accounted profit or loss from associates or joint ventures, tax expense or income as the case might be, total for discontinued operations, and then of course, finish off that document with the profit or loss. What you see on the screen in front of you is what was always called the income statement in days gone by, and which I guess we can still refer to as the income statement, because that's what profit or loss represents, the income and expenses that are not included in other comprehensive income. From the other comprehensive income perspective, the standard currently requires each individual component of other comprehensive income to be presented by its nature, and then also to include the other comprehensive income from equity accounted investments, culminating in the total comprehensive income for the year. And as I said, this could either be presented in a single document. So you'd start off at the top with the profit or loss items with the total of profit or loss for the year. Then you'd add in the other comprehensive income items at the bottom of the document and end up with total comprehensive income. Or some companies separated them out into two separate statements. Either of those is perfectly acceptable. Under IFRS 18, we see some similarities in terms of the line items. So we see, for example, that we need to present total revenue for the year, a requirement to distinguish between interest revenue and insurance revenue to the extent that that's applicable. So a company that only buys and sells widgets, for example, a retailer or a manufacturer, will have total revenue from contracts with customers. But a financial institution would probably have interest revenue that's calculated using the effective interest method under IFRS 9, and an insurer would have insurance revenue calculated under IFRS 17. So we need to differentiate between the different types of revenue, but have a total for revenue for the company. And then our operating expenses need to be classified by nature or by function. We'll come to that in just a moment, with specific requirement for cost of sales to be presented as well, if applicable. Not all companies will have a cost of sales, but if the company does have a cost of sales, a cost of inventory sold, for example, then there's a requirement to present that item as well as a share of profit or loss from equity accounted investments, income tax expense or income or single amount from discontinued operations. So it doesn't really change the line items specifically, but it does require, for example, additional disclosures around certain components of IFRS 9 gains and losses and insurance gains and losses that are recorded by the company. It's also necessary to present an allocation of profit or loss for the period that's attributable to non-controlling interests and owners of the parent company, owners of the holding company. And that's also consistent with what IAS 1 required. So far, nothing that I've described up to this point should be hugely unusual or different, but it just expands in a little bit more detail about some of these components of, for example, the insurance revenue or the insurance activities rather, and your financial instrument activities. Then an entity is also required to present any additional line items. Remember our discussion before the break? A line item is an aggregation of income and expenses. So you need to present additional line items if doing so is necessary to provide a useful structured summary of the entity's income and expenses. And that requires the use of judgment to determine what additional items to present, how to aggregate and disaggregate them, how to determine what the similar or shared characteristics are, or the not shared or dissimilar characteristics are. And that will help to determine the groupings or additional components of our statement of profit or loss, our income statement. With respect to the grouping of our line items, and now this, just to jump back to the previous slide for a moment. So the standard describes line items that need to be presented and describes how to go about determining what additional line items might be required. Once you've determined the disclosable line items, you now need to figure out how to classify those line items into one of 5 categories. And this is, of course, what's different, what's new under IFRS 18 as compared to IAS 1. As I mentioned already in the introduction, we now have an operating category, an investing category, and a financing category, which many of you have already identified or recognized as being similar to the categories of the cash flow statement. But that's not to say that what is operating a category for the cash flow statement will represent the same thing as operating category for the income statement. There are some differences, and the board is looking to see how and whether to minimize some of those differences. But right now, let's just put the cash flow statement aside for the moment. Let's take ourselves away from the cash flow statement and focus on these definitions, which I'll explain what they mean in the context of the income statement over the next couple of slides. The income taxes category and discontinued operations category are probably the easiest to explain, because the income taxes category is your total tax expense or income for the year, and the discontinued operations category is the profit or loss or income and expenses from your discontinued operations for the year. So those two are perhaps the less complicated, less judgmental, because we've got a very good point of reference in terms of identifying what those are in terms of the existing requirements. Just some additional pointers before we move into an explanation of the operating category is that foreign exchange differences from translating foreign currency transactions into your functional currency, the gains and losses arising from those will be classified consistently with the related income and expense that gave rise to the foreign exchange difference. That's quite an important point to mention up front, because currently, and this is one of the problem areas under the existing structure of the income statement, is that companies have taken to, in some instances, bringing all foreign exchange gains and losses together and presenting them separately for the purposes of the presentation. In terms of the requirements, if you've got a foreign exchange gain or loss that arises from something where the income and expense is anyway going to be reported in the operating category, had that transaction been denominated in your functional currency, then the foreign exchange gain and loss relating to that will likewise go to the operating category. And the same principle applies to your other two categories as well. The same principle then also carries forward into the classification of fair value gains and losses on derivatives, because it depends on whether you are using those derivatives to manage your risks and hedge, designating them as hedging instruments, as to where you would then classify the gains and losses from those derivatives. And accordingly, if you are hedging a transaction where the income and expense will be in the operating in the operating categories, then you will likewise take the gains and losses on the derivative instrument into the operating category accordingly. So the operating category, it applies to all income and expenses that are included in the statement of profit or loss, or the income statement, that are not classified in one of the other four categories. So our operating category is our residual category. And that in itself is a bit of a departure. I don't want to keep going back to how different it is from the cash flow statement, but the cash flow statement definition of operating category is a residual category, but it also specifies that you must take things that are your principal revenue producing activities into that category. IFRS 18 takes a different approach. It explains which income and expenses would be investing and financing income and expenses for certain types of entities. And if they are not classified as investing or financing activities, then they will go into the operating category of the income statement. In order to understand the operating category, we need to understand investing and financing. And then by process of elimination, we will find ourselves then potentially back in operating as a consequence of those assessments. Before, however, we look into the definition of the investing category and the financing category, it is also important that we classify our expenses and present our expenses according to either nature or function or both. Now, if you are already familiar with IAS 1, you are probably familiar with this concept as an existing principle that's been in the standards for quite some time, presenting an analysis of expenditure by nature or by function. However, it wasn't very clear when it's appropriate to use nature, when it's appropriate to use function, or whether it was appropriate to use a mixture of the two. The current language in IAS 1, and personally my interpretation of IAS 1 has always been that you couldn't mix and match. You couldn't have a combination of the two, because that would potentially then confuse the users of the financial statements. But IFRS 18 acknowledges that under some circumstances, a combination of the two might be appropriate. The nature of the expense talks more to what the expense is, versus the function of the expense, which talks more to what the expense is used for, if that makes sense. So, for example, if one takes a pen, if you go and you buy a pen from a stationery shop, the nature of that expenditure is of a stationary nature. It's stationary. But that pen might be used for administrative purposes, in which case it could be classified into the expenses relating to the administrative function, or it could be classified to manufacturing if it's used in the factory, or it could be classified to human resources if it's used for training. So how you are using the pen determines the function, and what the pen is determines the nature, or rather is the nature of the item. And that's where it becomes important to figure out what's most appropriate for this particular entity's presentation. when we group together our items, remember when I spoke about the grouping of the or the aggregation principles earlier, I mentioned that certain aggregation criteria could be by nature or by function, but that doesn't mean that that needs to be the same aggregation basis for all of the line items. In making the assessment of which is appropriate for the entity, the standard gives us some guidance to say you could consider which line items provide the most useful information about the main components or drivers of profitability. So, for example, a retailer or manufacturer might argue that cost of sales is a very important driver of profitability, whereas in a service-oriented business, that doesn't necessarily have a cost of sales as such, but where employee cost really drives the profitability of the company, you'd argue that the nature of the expense, employee cost, is more important to the users. Another factor to consider, which IFRS 18 highlights, is how is the business managed and how does management report internally? There could be a correlation, for example, between the assessment of the types or the grouping of expenses by nature or function and how segment information is reported internally to the chief operating decision maker. So if the chief operating decision maker regularly wants to look at certain key expense categories or groupings, and some of them are by nature, some of them are by function, that highlights that it's important then potentially also for the users of the financial statements to see those numbers as well. Another factor could be to look at standard industry practice, which then, of course, facilitates comparability across peers in the same industry. But that's not always the right answer because depending on the circumstances, that might not be relevant in your particular circumstances. So it could be an additional consideration, but I wouldn't say that that's what ultimately pushes you into a particular direction of classifying the expenses by nature as opposed to function or vice versa. And then another consideration, because classifying expenses by nature is relatively straightforward. I mean, in my example of the pen, it's very easy to identify a pen as a stationary item. But classifying it into the function could require judgment, and that judgment could be quite arbitrary depending on the degree of the various factors that ultimately impact the assessment, the judgment that's been applied. So where allocation of particular expenses to functions would be particularly arbitrary, that might then not result in faithful representation, in which case you might push more towards classification by nature. So the principles on this slide aren't intended to say, if this always go here, if that always go there. Rather, these are the factors that management needs to take into consideration in arriving at what's right for its circumstances. And as I said, in some instances, you may result in a situation where you've got a mixed presentation. If a mixed presentation is presented, in other words, some line items in the operating category are by nature, some line items in the operating category are by function, then it's important that the users are able to identify the differences and the implications of that by considering the labeling that is applied. For example, the standard says, if you've used a mixed classification and you are, I mean, for example, you may have certain functions that also incorporate certain employee costs. So for example, you may have your production function that includes employee costs, which ultimately will end up in the cost of sales number. And then you've also got the employee costs that are more for administrative purposes. Then it would be helpful to label that line item to say, these are the employee benefits, the nature, other than those that have been included in cost of sales, the function. And that way the user can make better sense to understand whether the function includes employee costs or not, firstly, and also to understand that these are the other items which were not taken into consideration in the composition of the total cost of sales as a function. So I think this is helpful because currently this is why there's been criticism around using a mixed approach under IAS1, is because under the existing guidance, a mixed presentation would have created more questions and confusion for the users, who would not have understood whether where the items have been included in the particular items. The standard does, however, have an overarching additional requirement for its disclosure. If operating expenses are presented by function, then it is important to also present additional information around certain specific expenses by nature. This is probably familiar to most of you because IS1 has required a version of this anyway. But what IFRS 18 does is it requires us to present this in a single note, providing totals for total depreciation as required by various IFRS standards, IAS 16 for property, plants, and equipment, investment properties under 40, and lease right of use assets under leases in IFRS 16, amortization of intangible assets under IAS 38, employee benefits under IAS 19 and IFRS 2 on share-based payments, if applicable, impairment losses or reversals as determined under IAS 36, and write-downs or reversals of impairments on inventories under IAS 2. So an illustrative example of that disclosure, this comes out of the supplementary guidance to the standards. And unfortunately, given the fact that the standard was literally issued a month ago, we don't have real examples that I can present to you. So I can only use the examples that came from IFRS 18 itself. But in essence, this requires a specific disclosure of specified expenses by nature that shows the totals for those items, where, for example, they might have been presented separately in terms of different functions. So in essence, what this is doing is it's saying, this is the total depreciation expense, and this is how it's been allocated across the different functions that are presented in the primary statement of profit or loss. There's total amortization. It's presented in research and development expense. So in other words, allowing the users to understand where these various items and how they've been presented across the various functions that have been presented in the financial statements. I see a couple of questions that have come in. Let me see if I can answer them at this point. If my company has impairment loss on receivables, should I present separately from the operating expense? Remember that separate presentation in terms of within a category is a function of aggregation and disaggregation and a question of materiality. So obviously, if you've got an immaterial impairment loss on receivables, then you don't have to present it separately. But if you do have a material amount, then you do need to include it in there. You will also see, as we go deeper into the discussion, that impairment losses on trade receivables will not fall into investing category or financing category, and therefore, by implication, will end up in the operating category classification. So in that sense, it's a question of materiality and aggregation as to whether they are presented separately, but they would be in the operating category of the statement of profit or loss. Then a question around minimum tax expense. Tax expense is, to the extent that it's an income tax expense, will fall into the income taxes category. There's no basis to put an income tax in terms of one of the other categories. I think that one speaks for itself. And then a question around not separating clearly between nature and function. I mean, this is part of the issue. As I said, nature is what the expense is, and function is what the item is used for. So that, based on the discussion I've had, I think I've already answered the question in terms of some of the factors that one would need to assess in terms of how and whether to group them into different groupings. And if a decision is made, what additional disclosure has to be presented in terms of the disclosure requirements. Right, let us then turn our attention to the investing category, the next new defined category that we have. Now, for the purposes of understanding this explanation, we have to understand that some companies will have certain operations that differ from others. And that's what we mean, by the first sentence on the slide here. A specified main business activity means that for some companies, income and expenses that would otherwise look to be of an investing nature would actually be of an operational nature for those companies. And the same goes for the financing activity section, which we'll come to in just a moment. So specified main business activity, I'll come back to that in terms of what we mean by a specified main business activity. But a specified main business activity means that the operations of the entity are such that there is an investing and or financing element to it that is also operational in nature for that type of business. And therefore, we would classify the income and expenses as operating. But for companies that do not have a specified main business activity, then the investing category includes all income and expenses from investments in associates, joint ventures, and unconsolidated subsidiaries. So this talks about your income, your equity accounted income and expenses coming from equity accounting, fair value gains and losses in relation to those, impairment losses in relation to those investments, as the case might be. It also includes income and expenses from cash and cash equivalents. So that means interest income and interest expense relating to cash and cash equivalents will be classified as investing category income and expenses if the company does not have a specified main business activity. And then any other income and expense arising from other assets that generate a return individually and largely independently of the entity's other resources would also be of an investing nature. And what I mean by that is things like income from an investment property, or where you have advanced loans and earned interest income on the loans that you've advanced to other companies, related party or otherwise, as the case might be. But again, subject to this not being a specified main business activity. So if you are a retailer or a manufacturer, and you happen to have a warehouse, an extra warehouse that you are renting out and earning rental income on, the rental income from that warehouse will be classified in the investing category and not part of your operating activities, or not part of your operating category. So the income and expenses is not just limited to interest. It depends on the nature of the assets. It depends on whether it's of a rental income nature or an interest income nature, or fair value gains and losses, or impairment losses, as the case might be. How we measure these various assets, these various investments, is still going to be governed by the respective standard that applies. In investment properties under IAS 40, lease income under IFRS 16, and then, of course, financial instrument accounting under IFRS 9. But the income and expenses that come from these items will all be presented in the investing category. And then linking it back to my earlier comment, if there are foreign exchange gains or losses relating to these income and expenses, they will also be in the investing category as well. With respect to specified main business activities, this is where the standard has an override for certain items or for certain companies with these so-called specified main business activities. And the standard basically identifies two types of main business activities. One is investing in particular types of assets, and that can either be, for example, the list is not endless, investment entities investing in different portfolios of equities, investment property companies or insurers, or you could have a company whose specified main business activity includes the providing of finance to customers, and that could include banks and lending institutions, or entities that provide financing to customers to enable those customers to buy the entity's products, or lessors that provide financing to customers in the finance lease space. Now, on this concept of main business activities, this is not to say now that this is the primary and sole purpose of the company. You may find, in fact, that some companies will have a single specified main business activity. If I'm a property owning company and my sole activity is to own a property, to rent it out and earn rental income, well then yes, that is not only my specified main business activity, but also my sole business activity. In which case then we would not classify the income and expenses arising from the rental income and fair value gains and losses on the investment properties as investing activities, but rather we would go to operating activities for that company. But you may have some companies that have lots of different activities. For example, you may be a manufacturer of a product that manufactures the product, sells the product, in some cases sells for cash, in other cases provides financing so that your customers can buy the product from you, in which case you have a specified main business activity together with another business activity, main business activity. And so you may have multiple main business activities. That's the point I want to make over here, is to say that this isn't a question of saying, what is your sole or only business activity? The assessment of whether you have a main business activity is going to involve judgment in some cases. In some cases, it could be a very easy answer. Where it would involve judgment is where you've got multiple activities. And that's where the standard says you have to assess all of the available facts and circumstances. You can't just say our main business activity is providing a finance and therefore change how you present your income statement if the evidence doesn't support that. This is very similar to other areas where similar judgments have to be made. For example, determining your functional currency for the purposes of IAS 21. You don't say we decide our functional currency is the US dollar or whatever currency. You need to assess based on how you operate, the environment in which you operate, what your functional currency is. Likewise, an investment entity can't simply say we are an investment entity under IFRS 10. One needs to see that their actions are consistent with those of an investment entity. And so for this assessment, you need to consider, for example, factors such as how does management run the business? For example, again, linking it back to segment reporting, which I think is a useful place to consider this, because understanding what the chief operating decision maker looks at for the purposes of identifying your reportable segments could probably indicate whether you have a main business activity and then assessing whether that ticks one of the boxes for being a specified main business activity. So you could have a company, using my earlier example, that has the manufacturing part of the business, and that's a very important part of that's a segment that the management looks at. But then there's also the providing a finance part of the business, and that's also a reportable segment, because management looks at that and makes decisions and allocates resources based on the numbers that are presented for that whole portion of the business. We've now got two main business activities, one of which is not specified. That's the supply, the manufacture and supply of the product. And then you've got another main business activity in the organization that is a specified main business activity. And that means that you will have to apply the principles of specified main business activities in relation to the investment in assets and the provision of finance relating to the specified main business activity as part of your operating activities. So let's just pause for a moment and take stock of what I've just said. A company that has multiple main businesses, some of which are specified, typically you'll find that the income and expenses relating to those activities will be of an operational nature. But to the extent that it involves, for example, returns from assets and things like that. On the non-asset related activities, for example, the manufacture and supply of products, that would be operating by process of elimination because it doesn't involve investing in assets, nor does it involve the provision and raising of finance. And therefore, by process of elimination, the income and expenses from those activities will end up in operating the operating category. So the standard will require companies, at least initially, and then on a continuous basis, to assess whether they've got a specified main business activity or not. And this slide summarizes the consequences of having a specified main business activity. Remember, let's just go back to one of the previous slides again for a second. The investing activity category says income and expenses relating to investments in other entities, cash and cash equivalents, and other assets that generate a return individually and largely independently. If it's not a specified main business activity, these are investing category income and expenses. If it is a specified main business activity, and you've got an investment in an associate, joint venture, or unconsolidated structured entity, or a subsidiary rather, that you are equity accounting, then even if it is a specified business activity, the standard requires this income and expense from the equity accounting to be classified as investing. If it is not equity accounted, and you are investing in the equities of the associate, JV, or subsidiary, then any income and expenses from the fair value gains and losses, or from the impairment losses, or any other adjustments that might come from this dividend income will be classified as operating income and expenses. If you've got investment in cash and cash equivalents, you'll see this one's a little bit more complicated. Cash and cash equivalents that generate a return individually and largely independently of the entity's other resources, and it's a specified main business activity to invest in these cash and cash equivalents, you'll classify the interest, income, and expenses as operating activities. Cash and cash equivalents not generating a return individually and largely independently of the entity's other resources, but where you are providing finance as a main business activity. We'll talk about financing in just a moment, but that will get us to operating activities. And if you've got cash and cash equivalents not generating a return individually and largely independently of your other resources, but you provide finance to customers as a main business activity, and the cash and cash equivalents do not relate to providing the finance to customers, then you have an accounting policy choice. And you'll see in a moment that that accounting policy choice should link up with the choice that you make on the financing side in just a moment, where you can either then classify the interest and expenses as operating or investing, as the case might be. If you've got other assets that generate a return individually and largely independently of your other resources that you invest in as a main business activity, then the income and expenses relating to those will be classified in the operating activities. Right. I see a question has come in for a translation of the illustrated financial statements. I'm afraid I'm not going to be able to address that one until such time as the IASB makes more translations in additional languages. We are limited to the ones that are currently available, but for the moment, I think the ones that I've included in the slide handouts are the English version, and I'm sure that in due course, additional translations will become available in time. Right, let's turn our attention to the financing category for a moment. The financing category determines what we need to classify in the third defined category of the income statement. And here we need to make a distinction between income and expenses related to liabilities that arise from transactions that only involve the raising of finance, and liabilities other than those involving the raising of finance. So a company might have a variety of different liabilities on its balance sheet. Some of them may have arisen from a situation where an investor has provided funding in the form of cash, and that cash will be repaid at some point in the future. Or in some instances, it might be a return of equity instruments, but through the application of various other standards in the IFRS framework, you will find that some items will have to be classified as liabilities irrespective of the method of settlement. And then so the question is, are they financing transactions or are they other types of liabilities that don't involve the raising of finance? Where you've got a liability that arises from a transaction that involves only the raising of finance, then you would classify the income and expenses from that transaction as a financing in the financing category. So, for example, a company that borrows money from the bank in order to fund its operations and repays interest and principal on that loan will classify the interest expense in relation to that as a financing activity. Any other consequential gains and losses from the initial recognition, the derecognition, all of that will also end up in the recognition of the item as part of the financing category of the income statement. And again, a reminder that foreign exchange translations of foreign denominated debt will also end up in the financing category to the extent that the interest itself or the income and expense related to that is part of the financing category. When we talk about solely with the raising of finance, and that, as I say, that's where you've borrowed money or you've issued debt instruments or you've got an obligation to purchase a variable number of your equity instruments. So various standards will tell you whether you've got a financing transaction or not. And anything to do with this. So for example, if you've got a preference share that's been classified as a liability because of the application of IAS 32, which is the standard on presentation of financial instruments, it might be that you are going to have to redeem the preference share, and even though it might be a component of share capital, in the balance sheet, it will be presented as a liability. The implication of that is that the dividend paid on such a preference share, which is a debt instrument, will also then have to be presented as an expense in the financing category of the income statement. Where we've got liabilities that arise from transactions that do not involve only the raising of finance. In other words, you've got liabilities in your balance sheet, but they arise from the application of other elements. For example, you've purchased goods or services that need to be settled in cash. You haven't received financing or raised financing. If you've bought goods on credit from a supplier, it's not that the supplier paid you money, gave you an advance, which you now need to return. You've received goods or services. So it's not a financing transaction in that sense. Where you've got a lease, for example, a lease is understood to be of a financing type. We understand it in economic terms as a form of financing, but actually what you've got is right of use of an asset in exchange for an obligation to make a payment. So again, it's not money that's been advanced to you that now needs to be returned. So your income and expenses from these types of liabilities, payables in relation to goods or services, lease liabilities, provisions that need to be settled for decommissioning provisions or litigation and things like that. Those types of liabilities would generally not be considered to be of a financing nature. However, there might be an element of the measurement of them that involves time value of money. So for example, the measurement of a long-term provision requires you to measure the liability at the present value of the future outflow of cash. And we have an effective unwinding of that financing element through the recognition of a deemed interest charge, which IAS 37, the standard on provisions, requires us to present in the financial statements. So what this slide is basically saying is that if another standard that deals with a liability that does not involve only the raising of finance, such as a lease, such as a payable for goods or services, such as a provision under IAS 37, if the other standard requires you to calculate and record an interest charge in relation to the measurement of that item, then that interest charge will be presented in the financing category of the income statement. Other changes in the value of these liabilities, for example, a change in the current or past service cost of a defined benefit plan, or expenses for the consumption of purchased goods or services in relation to the supplier. Those do not involve interest items by nature, and they would therefore form part, they will not form part of the financing category. They are likewise also not part of the investing category, which means by implication, those income and expenses will have to be classified in the operating category of the income statement. So let's just summarize what I've said up to this point. If it is straightforward interest that's been paid, just jumping back to the previous slide for a moment, if it's straightforward interest that's been paid and any other gains or losses arising directly from the provision of or the raising of finance, it's classified as a financing in the financing category. If it's a liability that is not a financing transaction as such, but there is an interest component identified by other standards in the application of the requirements of the other standards, such as an unwinding of a discount rate or whatever the case might be, then that interest, income, and expense is presented in the financing category. Any financing income and expenses from specified main business activities related to the provision of finance, which may also include, for example, the issuance of investment contracts with participation features under IFRS 9, insurance, finance income and expenses under IFRS 17, those would be excluded from the financing category. And then again, by process of elimination, because remember, if it's not investing, if it's not financing, it must be operating. That's where we would then take the income and expenses related to these types of transactions. Once again, we've got a summary slide over here that highlights the classification rules. So liabilities arising from transactions involving only the raising of finance where the liabilities relate to providing finance to the customers. So this might be, for example, where a company borrows money in order to on-lend that to its own customers, then that will be classified as part of your operating activities. Liabilities arising from transactions involving only the raising of finance where the liabilities do not relate to providing financing to the customers. Here's where we have an accounting policy choice again. And as I said, whatever choice you make in the classification of the liabilities or the income and expenses on the liabilities must likewise align to the accounting policy choice that you're making in relation to the related assets, if this is part of the same type of business activity. Liabilities arising from transactions not involving only the raising of finance with interest, income, and expenses where the entity has identified them separately. Financing, if it relates to the interest and expense, and operating for anything that is not interest, income, or expense in relation to such liabilities. See, a couple of questions have come in as I was, or comments have come in as I was speaking. Does the income or expense arising from changes in exchange rate go to financing category? No. Going back to my earlier comment right at the start, and I think I did repeat it again when we got further into this, any exchange rate gains or losses arising from translating foreign currencies into functional currencies link to wherever the related income and expense goes. So if you've got a foreign denominated loan, for example, and you've got foreign exchange gains or losses arising from the translation of the loan, and you've also got translations of the interest payments and things like, the payments against the loan, you will take the foreign exchange translation adjustments against the financing category if you're classifying the loan income and expenses in the financing category. Likewise, if it's investing, you take the foreign exchange gains and losses to the investing category. And if it's neither of the two, then it goes to the operating category by process of elimination. And I see a question here, what about other comprehensive income? We haven't gotten there yet. We're still coming to it, but hold your horses. We will talk about other comprehensive income in just a moment. The income taxes category is the one that includes all income tax expenses or income tax income that arises from the application of IAS 12, together with any related foreign exchange differences if it relates to foreign taxes. And the discontinued operation category includes all income and expenses from discontinued operations as required by IFRS 5, again, including any translation gains or losses, just to link it back to the earlier question that came up. So having explained the three new categories, and I guess explaining also then that the last two categories are simply the gains or losses coming from the application of two very specific standards. The idea now is that an income statement will essentially have certain defined subtotals, which creates a separation or segmentation between the three categories. So what IFRS 18 now does is it defines for the first time ever operating profit or loss as all income and expenses classified in the operating category. That's probably the easy one. Still need to figure out which are operating income and expenses, because you need to understand the other two categories first. But once you've got that, then the total of all income and expenses in the operating category is called operating profit or loss. Profit or loss before financing and income taxes is a new subtotal which comprises your operating profit or loss and all income and expenses classified in the investing category. And then your final total in the income statement, which was always there previously, is profit or loss for the year, which is the total of income less expenses included, the total of all income less expenses included in the statement of profit or loss. By implication, however, it also then is the difference between that total and that total must be all of the various other line items that fall in between there. Now, this doesn't mean that you cannot have other subtotals. You can still include additional subtotals such as gross profit, profit before tax, or profit after financing activities before tax. There's a variety of different subtotals you can use, but these are very specific subtotals and totals, which by implication, because they represent certain categories which are now defined formally in the standard, should in theory become comparable from one entity to another. So over the next couple of slides, I just want to give you a couple of illustrative examples. Again, appreciating that these are the only examples that exist at the moment, given that the standard is literally 4 weeks old and we do not have real life experience as yet in terms of companies that have published already, and also we don't have translations for the moment, but these come from the illustrative examples that accompanied the publication of the standard for those that want to refer to them in more detail. In this example, you've got AA Group, a manufacturer who does not invest in assets as a main business activity, nor does it provide financing to customers. So this is your typical entity without a specified main business activity. And this company management has gone through the process, the guidance in the standard, and determined that classifying its expenses in the operating activity by nature provides the most useful structured summary, because it believes perhaps that the main drivers of profitability are costs for raw materials and employment. So under the circumstances, the income statement for AA Group comprises the disclosable line items as we've seen them, as we've discussed them up to this point. We see that the total of operating profit must effectively be all the income and expenses that are not classified in the investing category or the financing category. They've classified by nature. They've used the description other, but even just looking at this, we can clearly see that given the composition of the other items that have been presented, it's unlikely that the other comprises material information. One could maybe elaborate further to say that other comprises immaterial items, or as the case might be. But in essence, it's clear to the users that they've disaggregated and presented the items by nature according to shared similar characteristics. Then we've got the share of equity accounted investments. Because it's not a main business activity that they are equity accounting, this is presented in the investing category. And so the next subtotal is profit before financing and income taxes, which is a total of operating profit plus income and expenses in the investing category. And then by implication, these are the interest and expenses relating to borrowings and other liabilities, and interest expense. Remember now the difference between the two interest expenses. This interest expense is where the company has essentially received a form of financing, whereas interest expense here is not so much that you receive financing, but it's a time value of money component of the valuation of a liability for a defined benefit plan. But in both cases, because it's not a specified business activity, it's presented as a financing category item. And we end up with profit or loss for the year. So just looking at this, this doesn't necessarily look all that different from what this company might have done previously. What might have been different is where it classified the interest. Maybe previously some of the interest might have been presented earlier, and maybe the equity accounted investments might have been presented differently. But by and large, it hasn't changed the bottom line for the company. It certainly would not have changed the balance sheet in any way. but it does allow for comparability because now we can compare this operating profit total with another company in the same industry or as a peer company and assess the performance on a more consistent basis. I'm not going to go through every example, but we are limited with time, but I've included quite a few examples in the handouts. But just to show you by comparison, the next example, this is a manufacturer who also provides financing to its customers. So it's not to say now that financing is the primary business. It's not a bank or a financial institution, but it happens to have both a supply of goods or services, so one would expect to see cost of sales, as well as the provision of financing, which implies then that there is an element of a financing cost that is of an operational type nature. And as a result of that, the company has also, I mean, just in terms of the background in the case study, the company has decided that they will present a mixture of some expenses classified by function and others by nature in the operating category because it provides a useful structured summary. And in the background information, we are told that the company has made an accounting policy election. Remember that for the financing categories and investing categories, if you've got a specified main business activity for certain income and expenses, you've got an accounting policy election, whether to present some of the income and expenses in the operating or in the financing or investing categories. So in essence, all I've done here is that you'll find that in the operating profit section, which is essentially, I mean, the operating category ends with operating profit, but included in the operating profit section is also interest revenue, which for another company that does not provide financing as a main business activity would have been of an investing nature. But because this is a main business activity for the company, there's both interest revenue and interest expense related to the providing of financing to customers, and therefore they've presented them as part of their operating activities section. Also look at the descriptions over here because the descriptions go further to clarify what the nature of their interest is as compared to other interest items that might be presented elsewhere, which then helps to clarify how a company has separated its presentation by nature versus function. I think we can do one more example before we move on to the next discussion area. This is an insurance company that invests in a main business activity that generates a return individually and largely independently of the company's other resources. They don't provide financing, but they do invest in their assets that are then used, obviously, to supply their or to meet their obligations in terms of their insurance liabilities. Now, in this instance, what I want to highlight is that IFRS 17 that applies to insurance contracts has certain specified disclosable line items. For example, the disclosure of an insurance service result is a disclosable item in addition to the disclosable line items that IFRS 18 carried forward from IS 1. And that means that you need to work through some of these to figure out which of these are disclosable because they are material in the context of the entity, or perhaps disclosable because another standard requires it, and management has concluded that the disclosure is not immaterial. Either way, what we see here is that everything to do with the activity of providing insurance services is sitting as operating activities. Equity accounted income from investments is an investing activity, and then interest expenses on borrowings and pension liabilities that are not related to the specified main business activity because they don't provide financing as a primary business activity would be presented as in financing activity cash flows. Not cash flow, sorry, income and expenses. I think you get the gist, ladies and gentlemen. In essence, each company's income statement will presumably look slightly different from others, but what you will find is that companies within the same industries will start to find a lot more similarity in terms of what is presented in terms of their income statements. I see a couple of questions that came in. Is IFRS 18 mandatory for IFRS for SMEs? No. It may at some point feature in terms of the next periodic review of the SME standard, but for the moment, the current comprehensive review that is underway is not looking to incorporate anything, mainly just because it hasn't been exposed to anybody yet and it's brand new. And the new SME standard is expected to become effective from 2026, which will precede the effective date of IFRS 18. So I think from a timing perspective, we can disregard IFRS 18 for the moment, but the next version might incorporate some of these elements into the next version of the IFRS for SMEs when that periodic review is undertaken in a few years' time. And then how does the profit or loss for a bank look? I think I've answered that already. I guess I can put the next slide up in answering that. This is an example of an investment and retail bank. Again, because of the specified main business activity of investing in assets, providing finance, you will see the elevation of interest revenue and interest expense as part of the operating activities, as opposed to the other examples where they were sitting under investing or financing activities. So everything that precedes operating profit for a bank is of an operating type nature. And then the only things that are presented as investing activities are equity accounted profits or losses from associates and joint ventures, and in this case, interest and expenses on pension funds and lease liabilities. Because of the accounting policy election to present certain items in operating activities, the company does not present the subtotal profit before financing and income taxes, but it basically gets you to more or less the same bottom result. Ultimately, the profit or loss is the same. It's just about how the items have been grouped according to the new grouping requirements. Right. I think let's just see. Apologies. I think I may have just switched off my screen. There we go. Apologies for that. Just want to clear the questions. One of the questions that came up earlier was, what about the comprehensive income, other comprehensive income items? So your statement of comprehensive income, or the statement that presents comprehensive income as it's now referred to. So they've tweaked the wording slightly, but at the end of the day, it still comes down to the same thing. You can either present in a single document your profit or loss totals, your other comprehensive income, and your comprehensive income for the year, which is the total of profit or loss and other comprehensive income. You can either do that in a separate document, or you can do it in separate documents or in the same document. The point is that wherever you present the profit or loss number, you need to present an attribution of profit or loss between non-controlling interests and owners of the parent. And wherever you present your other comprehensive income items, you need to present the allocation of comprehensive income for the period to non-controlling interests and owners of the parent. And in classifying your other comprehensive income items, you need to classify according to two distinct categories. So here there's no nature versus function. All other comprehensive income items are presented by nature, but the distinction that we have to make is whether the income or expenses presented as other comprehensive income will subsequently be reclassified to profit or loss when specific conditions are met, and those that will not subsequently be reclassified to profit or loss when specific conditions are met. So in essence, if you present it all in a single statement of financial performance, you will have your profit or loss section, which has the three categories as we've discussed up to this point. You'll have your other comprehensive income section that has your OCI items that will subsequently be reclassified and those that won't be. And in essence, you will have then your total comprehensive income for the year, which is then allocated to the owners of the business and the outside or non-controlling shareholders. Within the presentation of the statement of comprehensive income, also remember that where you are equity accounting investments in associates or joint ventures or subsidiaries in the separate financial statements of the parent, that you must also include your share of the respective line items of the investees' other comprehensive income on the same basis that I've just explained here. In other words, the nature of it doesn't change because it's the OCI of the associate that is then brought into the consolidated financial statements. You still need to classify or specify how much of the equity accounted OCI adjustments will be reclassified and which will not subsequently be reclassified. With respect to the items that make up other comprehensive income, just to illustrate the point, there has been no change made to the items that comprise other comprehensive income, ladies and gentlemen. So for the purposes of this assessment, other comprehensive income represents items of income and expenses that, for specific reasons within the IFRS standards, for specific reasons, the standards either require them to be excluded from profit or loss temporarily. In other words, it's the OCI recognition is a mechanism to temporarily bypass the earnings in the statement of financial performance, rather the statement of profit or loss, until some event occurs, some realization or other event occurs, at which point it's then recycled back into or reclassified back into profit or loss. Or in other instances, the mechanism of other comprehensive income is to permanently exclude the items of income and expenses from profit or loss because the standard setters believe that it's not appropriate to include these types of gains or losses in profit or loss. There is no principle that I can teach you here today around whether something would be in other comprehensive income or wouldn't be, as the case might be. We could do a little bit of an exercise. I'm just mindful of the time that's available to us. I don't want to run out of time on the session. So rather than doing the exercise now of asking you what you think should be in other comprehensive income, what this slide basically represents is that there are currently 1, 2, 3, 4, 5, 6, 7, 8 possible examples of other comprehensive income. And if you have a transaction that does not meet one of these 8 conditions, it is not included in other comprehensive income. If it does meet one of these 8 conditions, then it is included in other comprehensive income. There is a specified standard that will tell us about what that item is and when to include it in other comprehensive income or not. And that standard will also tell us if the item is subsequently reclassified to profit or loss or not. So there is, as I say, no conceptual basis that I can teach you or impart to you because the standard setters themselves do not have a clear conceptual basis for differentiating between when to reclassify or when not. It is essentially, in this instance, a set of rules. There are 8 rules that say when it's included in other comprehensive income and when it is not. And so for your benefit, I'm just going to share the slide with you. I'll go through them very briefly. This is your cutout and keep slide. So if you want to take a screenshot of the screen for the moment, or if you want to quickly try and jot it down, as I say, nothing has changed through the introduction of IFRS 18 insofar as this concept is concerned, because it's not IFRS 18, it's not IS1, it's not IFRS 18 that tells us whether something is in OCI or not, or whether it's reclassified or not. All IS1 and all IFRS 18 do is they tell us where to present it and how to deal with it from a presentation perspective. But it's these standards that tell us whether something is in OCI or not. The first 4 items grouped over here confirm that essentially the OCI mechanism is a temporary parking space for the moment to allow for either an unrealized gain or loss to be deferred until it is eventually realized, as is the case, for example, with the recognition of a foreign currency translation reserve under IAS 21, or where you are collecting cash flows and selling debt instruments as your business model in terms of the application of IFRS 9, or where you are applying hedge accounting, either a cash flow hedge or a hedge of net investment in foreign operation, where the OCI treatment is a temporary mechanism for the application of hedge accounting. In all other instances, the revaluation surplus on property, plants, and equipment or on an intangible asset, while we record the gain or loss in other comprehensive income, it is not reclassified subsequently. You can transfer it from the revaluation reserve to another component of equity in the statement of changes in equity, but it will never come back as a reclassification adjustment into profit or loss, which means we don't have to classify these as operating, investing, or financing for the purposes of our income statement. However, these items at some point will have to be classified as operating, investing, or financing, because when they are reclassified to profit or loss, they will need to fall into the appropriate grouping according to the principles we've been discussing up to now. Own credit portion of fair value movements on our own debt instruments that are designated at fair value through other comprehensive income. Changes in fair value of a designated equity investment that is not held for trading, and remeasurements of defined benefit plans under IAS 19. Those are also permanently in other comprehensive income. Right. Moving across then to our statement of financial position. I just want to wrap up 2 more points, and then we can talk about management performance measures and the transition, and that should take us to the end of the session. 15 minutes left. Our statement of financial position is largely the same as it was under IAS 1. Nothing changes insofar as how we present it and the structure and all of that. We still have assets. We present separately from liabilities. We should provide a current versus non-current classification unless a liquidity basis provides more relevant and more useful information, in which case then we present our assets and liabilities in descending or ascending order of liquidity. Remember, there is a recent amendment to IAS 1 around the classification of current liabilities that came into effect earlier this year, and that confirms that you classify a liability as current if you do not have a right of deferral that is substantive, that exists beyond a right of deferral beyond 12 months that exists before the end of the reporting period. Irrespective of your classification method or where you've classified the assets and the liabilities, the standard does require us to present or disclose the amounts expected to be recovered or settled after more than 12 months for each asset and liability line item that combines amounts that are expected to be recovered or settled no more than 12 months after the reporting date and more than 12 months after the reporting date. Depending on how you've structured and grouped these items, you may find that you automatically present that anyway by virtue of your classification, but it may need to be supplemented further by additional explanation. For example, an entity might have a receivable that is repayable on demand, but the entity only expects to recover it more than 12 months after year end. That requires additional disclosure. Our statement of changes in equity comprises all of the movements and transactions with the owners of the company acting in that capacity. In other words, you may have transactions with owners, but the owners are also suppliers. So to the extent that there are purchases and sales relating to suppliers or customers, those are recorded in the income statement, even if they also happen to be owners of the business. But what we're talking about here are owner transactions, the issuance of equity, the redemption of equity, the payments of dividends, and so on and so forth. And so these movements in relation to these equity components are presented in the statement of changes in equity, together with the comprehensive income for the period attributable to the various groupings of owners in the group. And that also is largely the same as it was under IAS 1, so nothing much has changed there. Regarding the structure of the notes, remember that we said earlier that the role of the notes is to expand on and provide more information around the information presented in the useful structured summary of the primary financial statements. So the notes need to include information around the basis of preparation, any information that an individual IFRS accounting standard might require to be disclosed, and then, of course, any additional information that management believes is necessary for an understanding of the financial statements, even if there is no specific disclosure requirement in a particular IFRS accounting standard. And that's always an overarching consideration when assessing disclosures, is to take a step back and say, based on the minimum disclosure requirements in the standards, is a user going to have enough information available to understand the information? Or do we need to provide additional information in our disclosures so that the users can fully appreciate and understand the information? Regarding the structure of the notes, IAS 1 never really defined any formal structure, and nor does IFRS 18 formally define any particular structure. The standard does require that the notes are presented in a systematic manner as far as practicable, but there is no prescribed order. What is important, of course, is that there's appropriate cross-referencing between the primary statements and to the notes and back again and across the notes. And so management must come up with must apply judgment to come up with a useful order that may, for example, and these are just some suggestions, it's not to say that you're going to tick all boxes here, but for example, consider giving more prominence to the areas of activities that are most important in understanding the financial performance and position. If I'm a bank and I have lots of financial instruments as part of my operations, it's not helpful for me to stick all of my financial instrument disclosure notes right at the very back, just simply because the template that I've purchased happened to stick them in that order, because retailers don't, and manufacturers don't generally have that front and center. One needs to consider bringing forward and elevating the most important aspects of the information. Another area to consider is to group items that are measured similarly, because then some of the disclosures can at least align with one another, and you don't, for example, have inconsistent disclosures. For example, if you have different assets measured at fair value, there are certain disclosures required around how the fair values were determined. And if you scatter the items across the financial statements, you might have more detail on one item and less on another, when ultimately the same type of information is required. Another example is to follow the order of line items in the primary statements, but there itself, one needs to consider what is the appropriate grouping of line items, which will then help to inform this discussion as well. Another trend that you might have seen, and we discussed in one of the case studies in one of the earlier webinars a few years back, is the tendency of bringing all the information together, which I think is quite helpful, where a company brings the accounting policies, the significant judgments, the risk disclosures, as well as the reconciliations and other quantitative disclosures together in one place, so that the user can then find all the necessary information to understand the numbers from the primary financial statements with one link, rather than having to go hunting for the information across different sections. Which takes us to the third fundamental change in IFRS 18 that has been introduced, and that is around the disclosure of management-defined performance measures. A management performance measure is a subtotal of income and expenses that an entity uses in public communications outside the financial statements, which it uses to communicate to users of the financial statements management's view of an aspect of the financial performance of the entity as a whole, and is not specifically required to be presented or disclosed by an IFRS accounting standard. So these are the so-called non-GAAP measures, or entity-specific measures, whatever you want to call, alternative performance measures, as you choose to call them. That being said, while we do have certain defined subtotals, which I mentioned on one of the earlier slides, I did say that a company can present additional subtotals, and for the purpose of our discussion here, these would not be considered management performance measures, even though they aren't necessarily formally defined and required mandatory disclosures according to the discussion we had earlier. So where a company, for example, presents a gross profit line, which is understood to be revenue minus cost of sales, that's not a management performance measure, because it's just basically an intermediate subtotal within the operating activities or the operating category. And so that would not fall within the scope of the disclosure requirements of a management performance measure. The same goes for some of these other line items: profit or loss before income tax, operating profit or loss before depreciation, amortization, and impairments. Now, some of these might be familiar to you. Some of you might already be seeing these in practice. What you won't see over here on the list is things such as EBIT, earnings before interest and tax, or earnings before interest, tax, depreciation, and amortization, EBITDA. Those are often presented by different companies, but you'll notice that they don't quite really fit in specifically. I mean, one could maybe argue that operating profit might be similar to EBITDA, but it's not quite the same, because operating profit or loss before depreciation, amortization, and impairments, this is taken into consideration elements that EBITDA might not. During the development of the standard, the IASB considered introducing a defined subtotal for these other measures, EBIT, EBITDA, and the list goes on. But stakeholders providing feedback couldn't reach consensus in terms of which ones to use, what EBIT represents, what EBITDA represents, and why it's so important. And so the thinking was that these types of items that are not specifically specified on this slide or defined in the earlier slide in terms of the required disclosures would then be considered management performance measures to the extent that the entity uses that measure in public communications outside the financial statements and uses that measure to communicate an aspect of the financial performance of the entity as a whole. So to the extent that management in its public communications, for example, highlights in a news article or in a circular or in an announcement that EBITDA rose by a certain number or a certain percentage, that would presumably, and if management believes that that is an indication of the performance of the company, then that would need to be treated as a management performance measure, which requires disclosure within a single note of all and any management performance measures that management believes are relevant in assessing performance of the company. So this introduces a bit of discipline in terms of how these are elevated and presented. You would not be permitted to present this on the face of the statement of profit or loss, but you can in the note highlight this and explain that this is an alternative view of the performance. You would need to explain, provide a description of the aspect of financial performance and explain why management believes that it is useful information to assess performance. You need to explain how the measure is calculated, what goes into the determination of that number, and then a reconciliation between each management performance measure and the most directly comparable subtotal that's either required or permitted. Remember those two slides I mentioned? The most recent slide that said these are not management performance measures, reconciling to one of those items or to the required disclosable line items that we spoke about earlier, being operating profit or loss after interest and income taxes. And then, of course, it's also important for the users to understand the income tax effects and the effects on the non-controlling interests for each item within this reconciliation that I referred to above. So this is quite new. This is something that companies have probably never done before, but which will now have to do if these companies want to either start providing these management performance measures. Remember, there's nothing that says you must have management performance measures, but if you do have these alternative subtotals or these alternative measures that you believe are important for users to understand performance, then this is what would be required disclosure in relation to those. As an example of the disclosure, I'm not going to go into a detailed analysis of all of the wording. Again, this comes out of the supplementary guidance that accompanied the standard. But this, for example, explains why management felt that, in this case, management's management performance measure is an adjusted operating profit from continuing operations that tries to adjust for certain items that are not expected to arise in future periods. In other words, unusual or non-recurring items, which management feels are perhaps distorting the financial performance on the basis that they are once-offs. Now, you can't argue that this now means that because it's a once-off, it shouldn't be in the income statement, because there's no way that you can argue that exceptional or extraordinary items are excluded from the income statement. But if you want to show the effect of this, to say that management does not believe that these are indicative of performance, these are the items that have been adjusted: impairment losses, restructuring expenses, non-recurring litigation expenses, and so on, disposals of property, plants, and equipment that aren't expected to recur. Those effectively then would need to be reconciled by taking the closest IFRS number, which would be profit from operating profit, showing the effects of these adjustments, as well as the income tax effects and effects on non-controlling interest, and arriving at the management defined performance measure that is communicated to the users of the financial statements. If a company changes its management performance measures, then either in terms of how it calculates the measure, or adds a new measure, or ceases using a previous measure, or changes how it determines the income tax effects, then appropriate explanations and disclosures are required in terms of what the effects of the change are, the reasons for the change, and the fact that the comparatives must be restated to reflect the change to the extent practicable, so that at least you've got comparability between these measures from one period to the next. Ladies and gentlemen, I appreciate we are almost out of time. I just want to wrap up 2 more comments, and then I think we might run over by a couple of minutes. Remember, of course, that there's also a requirement to provide information about management's policies and objectives for managing capital. That carries forward from IAS 1, so nothing really new there. But just elaborating further, and I suppose it links back in some respects to some of the judgments that have been made around here in terms of what the objectives are, what the risks are, what the strategies are, and of course, any compliance or non-compliance with any externally imposed capital requirements. This has largely been lifted forward unchanged from IAS 1. And then also disclosure around categories of share capital, the purpose and nature of each reserve, and the amounts of dividends declared or proposed and recognized during the current period. This also carries forward unchanged from IAS 1. Just some closing comments then regarding transition and effective date before we wrap up the session. I've already answered the question that the effective date of the standard is 1st of January 2027, with early application permitted. When a company adopts IFRS 18 for the first time, it will have to restate its comparatives accordingly to achieve comparability. That's one of the fundamental points I mentioned earlier. Now, the key thing here is that, as I mentioned with some of the examples, some companies might simply just find that IFRS 18 shifts a line item from one place to the next, and that's the extent of the change. And if that's the case, nothing prevents a company from adopting it immediately. The purpose for the long lead time of 3 years, the standard was issued last month and only becomes effective in 27, because other companies might find, firstly, that now they need to assess whether they've got a specified main business activity. And that could require new information that now needs to be gathered that might not have been gathered previously. It may also require changes to systems in terms of gathering the information necessary for making the splits and the aggregations and the disaggregations of information. So with that type of change, with that level of change, the impact could be more significant for some companies than for others. Remember that you are only required to present an additional comparative balance sheet if there was a change to your balance sheet preparation or presentation in terms of retrospective application. In this instance, to the extent that it's only affecting your financial performance disclosures, your income statement and comprehensive income disclosures, then there should be no need for a third balance sheet for most companies. But if you are also making other changes, other restatements, then don't forget that there is also a need for the additional comparative balance sheet to be presented. The other thing, of course, is the determination of the management performance measures and how they are presented, because previously companies might have been reporting these management performance measures with no further explanations. And again, the reconciliations required, determining the income tax effects, that could be more tricky for some companies than others, which is why the standards have given us an extended period of an effective date here. With the adoption of the new standard, or when the new standard becomes effective, IAS 1 will cease to exist. There have been numerous terminology changes made to various other standards that used to refer to IAS 1. So in some cases, it's just referring to the new standard. But you'll also notice the tendency that we now refer specifically to IFRS accounting standards as opposed to IFRSs or IFRS standards, to differentiate between these and the sustainability standards of the IASB. Another interesting development is that IAS 8, which currently refers to changes in accounting policies, changes in accounting estimates, and corrections of errors, has now been renamed to the basis of preparation of financial statements. Doesn't change any of the existing requirements around the selection and adoption of accounting policies, the changing of accounting policies, corrections of errors, and changes in estimates. But what's happened is the guidance has been shifted slightly, because IAS1 used to include a lot of guidance around the disclosure of accounting policies and things like that. That's been moved into the new IAS8 basis for preparation, which explains how you determine your accounting policies, how you apply your accounting policies, and what needs to be disclosed in relation to those accounting policies. And then there are some specific presentation and disclosure requirements in other standards that have also been updated to reflect this. So certain line items or references where perhaps a standard said an entity shall disclose either in the primary financial statements or in the notes. Now the guidance of IFRS 18 will tell us where to present it, rather than the individual standard telling us where to present it. Other standards that have been affected, IAS 7, I mentioned in passing on the statement of cash flows. While the definitions of operating, investing, and financing activities of the statement of cash flows are not identical, there are some similarities, but the IASB is working on a project on looking at IAS 7 comprehensively to see whether any further changes are required there. For me, the biggest change coming out of this in relation to the statement of cash flows is that previously IAS 7 allowed for a choice of classification of payment of dividends and the classification of interest paid and interest and dividends received. And the requirements of IFRS 18 now say that dividends paid must always be classified as financing activity cash flows. There's no longer a choice to take that to operating cash flows. And for companies that don't have a specified main business activity, interest paid will always be financing, and interest and dividends received must always be investing activities. For companies that do have a specified main business activity, then you would classify accordingly into your operating activities section of the cash flow statement. And then lastly, I mentioned IAS 8, so new title, and just carrying forward a lot of the basic principles around the application of accounting policies and basis of accounting. And then in the interim reporting guidance, IAS 34 has been amended to conform with the descriptions of the primary statements as per IFRS 18, but also to highlight the fact that the concepts of aggregation and disaggregation apply equally within an interim period, so that you don't end up in a situation where a company overly aggregates information on an interim basis, that it would be inappropriate in the annual financial statements. Also, a new requirement that if a company discloses management performance measures in the interim financial statements, that the disclosure requirements of IFRS 18 apply also in the interim financial statements. Ladies and gentlemen, the remaining slides in the slide deck, for those that are following along, are just a summary, but in essence, IFRS 18 is going to be something that we all need to get our heads around. Some will do it a lot easier than others. The big takeaways are the new layout of the statement of financial performance, the income statement, new guidance around aggregation and disaggregation, which will hopefully lead to more useful information and less obscuring of material information in the financial statements, and of course, the disclosures of management-defined performance measures. The remaining slides, which I won't go into detail on now, are just some further illustrative examples that I included from the standard. They are available in the standard itself, so if you can access the standard, you can access these, but it is just a nice little summary of our discussion points. And on that note, then, we've reached the end of this afternoon's webinar on IFRS 18. I'm going to pause for a moment to see if there are any remaining questions. I see there have been some comments that came through. Questions around the sharing of the slide presentation. I think that will be delivered via the post-course materials. I don't see any questions as such. So I think from my side, Casey, I don't know if you want to have any closing comments from your side.
Blaise, I would just like to say thank you very much for sharing your expertise in a very comprehensive presentation for us today. And IFRS 18 is going to make our financial reports more consistent, more understandable. The changes are very intuitive and are going to resolve some uncertainties that preparers have had. So it is a welcome standard. Thank you very much, Blaise. And also thanks to all of our participants here today. I see that we are joined by Mr. Chen Pat, Deputy Director of the Accounting and Auditing Regulator. Mr. Chen Pat, thank you very much for joining us. and Hank Pena from the Trust Regulator. Again, thank you. And we have a lot of our friends and associates from the Big Four and the audit firms here. So everybody, welcome. Thank you for joining us. And Blaise, again, thank you for sharing your expertise. Hope that we can schedule a visit to Cambodia. You can give a presentation in person, and you can visit Angkor Wat. I can say it's a bit hot right now, so maybe if you can think of some free time in November or December and January, those are the cool months here in Cambodia. So I hope that we can welcome you here to Cambodia.
Absolutely, it will be my pleasure. Thank you very much. I look forward to engaging with all of you. Thank you.
And everybody, friends, please have a wonderful weekend, Sunday afternoon, Sunday evening, and wish you all the best.
Bye-bye, everybody.
Goodbye.